Alrighty, so we've gone through the overall sort of high level trade plan. Well, in some detail, it's not super high level, but you guys got hopefully started to get the picture of what it is we're trying to do. So kind of before we dive into the actual liquidity concepts, it's probably useful to actually kind of roughly see what that plan looks like on an actual chart. Now, this isn't going to be that in depth. I'm not really kind of going to properly go through this in detail, but I kind of just want to show you loosely and quickly kind of what we're trying to do here. But we'll go into this in a lot more detailed walkthroughs and really dive into trade plans in later lessons. So for instance, let's kind of first look at an example if you're taking more of that swing trading approach. So you are going to be entering on 4-hour POIs with M15 timing, right? So this 4-hour range, I won't bother doing the daily analysis just for the sake of keeping it simple in time. And you would have, you'd be looking at the unmitigated POIs here. So we can see with the benefit of hindsight that one got swept and we just ended up rejecting the range. But that would generally be the idea, okay? So there'd be likely some 4-hour supply to the left. So after a break of structure, you would be looking for price to come into here, and then on a lower time frame on the M15, right? Looking to see if we get those M15 entries to play the, to play that 4-hour pullback, right? This was price action in the end of the year, so it's typically slow and corrective. But yeah, we then come down into the 4-hour POI. So at this moment, if we think there's a decent probability that this could be the move that continues, what do? We jump down to the M15 and look for your entry models, right? That's what you would do at that time. Okay, so we end up hitting a refined M15 level within here, right? So now you've done what? Now you have hit your medium time frame POI, right? You have the higher time frame objective potentially complete. We've had the daily pullback into 4-hour demand. So now you're looking for your lower time frame execution, which is your M15, okay? Again, not going to get too caught up in entry models, but very quickly, we get the mitigation, we get the shift in structure, we get the V-shape reaction, right? You have the flip, react in there, and then we get the continued movement, right? And that would be your trade. Targeting to the upside. We're not going to get too caught up in management and things like that, okay? Ends up not working, we come down a little bit lower. And where do we come into? We come into the 4-hour extreme, okay? So now, again, what do? As soon as price mitigates that level, our alert goes off, jump down to our execution time frame, okay? And then you look for your lower time frame entry model. I'm not going to get into the details of it, but you can generally see, right, structure shifts in our favor, down into the demand that caused it, and there's your trade. And now what you can do is potentially target all the way up to the week high, right? Because we've had the pullback to our POI, we've entered that POI with our lower time frame execution model. So now there's a high probability that pullback is now over, and now we can target the week high, right? That's the general idea of what we're doing. Now, of course, there's a lot of other stuff that can happen in between. We can look for continuations from within here. We can look for counter trend moves, but that's sort of the bread and butter stuff of what we're trying to do, okay? Sort of another brief example where, again, it gets a bit more complex, where we can get complex ranges, and especially if you're taking more of that day trading approach, where we have this 4-hour range here, right? Break of structure. We've come deeper into 4-hour supply, so we can look to play that swing pullback into 4-hour demand, right? To then potentially look for the move to go. So imagine this is our higher time frame. So when we're trading here, we would then follow the M15. We would look for the M15 to switch bearish, right? And we would look for that to stay bearish into the 4-hour POI. And then if markets were nice and easy, like sometimes they can be, but rarely are, price would then mitigate our higher time frame zone. Our medium time frame, the M15 would then switch bullish, right? And then we would hopefully follow the M15 strong lows until it takes out the high. But as you're about to see, it can get a little bit more tricky than that in reality. And then eventually we come in, and then that happens, and then eventually we go, okay? So 4-hour would then be our higher time frame. So then if we drop down to the M15, again, I'm not going to go through this in exact detail now, but just to give you a rough idea of how markets can move, which I'm sure some of you are aware, right? We come into, or we get that break of structure. So down here is our M15 swing low. It's quite a big range. We get an internal pullback. We just change color of this. All right, we mitigate our extreme refined M15 POI within our 4-hour POI. Now, technically at that time, you could drop down to your execution time frame, say the M5 or the M1, and look for entries. But probably with a lot of momentum and everything, it can just be best to be patient, right? In this instance, you could wait for an IBOS, right? So again, not going to go into too much detail, as tempting as it is, but we get a reaction from demand, we push up and we push down. So now we have a big flip. But more importantly, the structure is bearish, right? The internal structure for the M15. So now you have a strong high and you have a weak low, right? So price pulls back up, we can look to short. As soon as price comes into our M15 POI, drop down into the M1, right? And then from within here, there'll be M15 POIs that can form, and each time you can look for entries on the M1 to try and follow that order flow to do what? To target that weak low, right? Then we get another M15 boss, but where have we come into? We've come into a refined M15 POI within the 4-hour demand, right? So remember the higher time frame objective, it could have now pulled back, and now the 4-hour chart may be ready to make that higher high. So what do we expect? Then we expect that the M15 internal structure can potentially shift bullish, which is what ends up happening, right? So you can look for M1 entries from within here, right? And we get M1 entries within these POIs, right? All of these, there's little, order flow within here, M1 entry, right? Break of structure, M15 POI, M1 entry. Not saying you should take all of these or that high probability, that's what we'll get into, but it's the general idea of what we're doing, the direction and the order flow and the higher time frame philosophy of what it is. So then we get that bullish IBOS, right? So now the internal structure is aligned. This is now a strong low. We come into old supply. What is old supply? It should just be reaction points for pullbacks. So as soon as we have our medium time frame mitigation, our M15 POI, what can we do? We can jump into the M1 and look for shorts to play that pullback, right? Again, we can play this whole move. Look for shorts from within here. As soon as price comes in, jump in the M1. Now we come into demand near the strong low. Now what can we do? Now we can look for longs, right? Or wait for M15 to give a bullish chop, come in here, look for longs on the M1, come up, look for longs on the M1, right? As soon as we come back into that M15 POI, right? Then we take out the weak high, and we pull back again into demand. Look for longs on the M1, right? Mess around, try to break the highs, sweep liquidity. We're at least expecting an M15 pullback now, right? Again, screw out, and I'm going a little bit quick here, but I don't want to kind of get too stuck in the detail here. But again, we have that internal structure. We sweep, bearish structure here, M15 POI, jump in on the M1, come down, up to M15 POI, jump down to the M1. We're just playing the pullback. We would expect that low to hold. It doesn't. Well, as we get into liquidity concepts, you'll see as we see all these sweeps, external range liquidity and all that fun stuff, we have reason to believe this low may now go, which it ends up doing. We now get a bearish IBOS, okay? So now this becomes a strong high. We look for price to pull back up into our M15 supply zones, jump into the M1, right? Look for shorts, price pulls back into M15 supply, jump into the M1, target the weak low. We get a break of the low, okay? But we're coming back down into 4-hour demand. So again, there's an increased probability the 4-hour could take over and we could switch bullish. The internal M15 internal structure does try to shift bullish. Old supply becomes reaction points for pullbacks. Again, we can look for shorts in the M1. Perhaps we can get long on the M1 here, right, to try and get the continuation. It ends up failing. We are in a big, messy range at this point. Again, not getting too lost in detail. We then shift bearish again. So this then becomes technically a strong high. But where are we on the higher time frames? Remember, the higher time frame is king. We've now pulled, deeper into that 4-hour POI, right? Refine M15 within here, look for M1 entries. Come in, flip M15 demand, look for M1 entries, right? You can even look to play the move, the short from within there, right? Depends on how active you want to get, right? Back into M15 demand, M1 entries, back into M15 demand, M1 entries, right? You could even be aggressive within this level, look for shorts from within here, demand holds, flip supply, back into here, look for M1 entries, right? It's not saying, again, none of this is, you shouldn't just be trading every M15 POI. There's going to be a lot to this, right? And this is a particularly advanced and tricky piece of price action. But it's just showing you the kind of, I'm trying to keep it to that kind of high level framework of higher time frame idea, right? Pull back into here. It doesn't always just happen smoothly, and then we go. But that whole time, whilst that's in the back of my mind of what's going on, I'm trying to use the M15 structure as like sort of my immediate bias. So we're within this bearish range, kind of want to focus on shorts from supply. But that doesn't mean you can't look for longs from within here. It's just they might not be as high probability. Then when we get short from within here and we start moving down, target the weak low, right? Come into here, you can look for longs in case that's the movement, so on and so forth. So it's M15 ideas, M15 POIs, lower time frame execution, but being aware of the bigger picture of the higher time frame will more often than not help you to understand how the M15 or your medium time frame is going to behave. But yeah, we will really dive into that, all of that really slowly. Okay, I've deliberately kind of gone over this at a quick pace, but it's just so you can kind of, like I keep saying, have that kind of high level grasp of the general philosophy of what it is we're trying to do before we now go and get dive deep into the source. Alrighty, so we've gone through the overall sort of high level trade plan. Well, in some detail, it's not super high level, but you guys got hopefully started to get the picture of what it is we're trying to do. So kind of before we dive into the actual liquidity concepts, it's probably useful to actually kind of roughly see what that plan looks like on an actual chart. Now, this isn't going to be that in depth. I'm not really kind of going to properly go through this in detail, but I kind of just want to show you loosely and quickly kind of what we're trying to do here. But we'll go into this in a lot more detailed walkthroughs and really dive into trade plans in later lessons. So For instance, let's kind of first look at an example if you're taking more of that swing trading approach. So you are going to be entering on 4-hour POIs with M15 timing, right? So this 4-hour range, I won't bother doing the daily analysis just for the sake of keeping it simple in time. And you would have, you'd be looking at the unmitigated POIs here. So we can see with the benefit of hindsight that one got swept and we just ended up rejecting the range. But that would generally be the idea, okay? So there'd be likely some 4-hour supply to the left. So after a break of structure, you would be looking for price to come into here, and then on a lower time frame on the M15, right, looking to see if we get those M15 entries to play that 4-hour pullback, right? This was price action in the end of the year, so it's typically slow and corrective. But yeah, we then come down into the 4-hour POI. So at this moment, if we think there's a decent probability that this could be the move that continues, what do? We jump down to the M15 and look for your entry models, right? That's what you would do at that time, okay? So we end up hitting a refined M15 level within here, right? So now you've done what? Now you have hit your medium time frame POI, right? You have the higher time frame objective potentially complete. We've had the daily pullback into 4-hour demand. So now you're looking for your lower time frame execution, which is your M15, okay? Again, not going to get too caught up in entry models, but very quickly, we get the mitigation, we get the shift in structure, we get the V-shape reaction, right? You have the flip, react in there, and then we get the continued movement, right? And that would be your trade, targeting to the upside. We're not going to get too caught up in management and things like that, okay? Ends up not working, we come down a little bit lower, and where do we come into? We come into the 4-hour extreme, okay? So now, again, what do? As soon as price mitigates that level, our alert goes off, jump down to our execution time frame, okay? And then you look for your lower time frame entry model. I'm not going to get into the details of it, but you can generally see, right, structure shifts in our favor, down into the demand that caused it, and there's your trade. And now what you can do is potentially target all the way up to the week high, right? Because we've had the pullback to our POI, we've entered that POI with our lower time frame execution model. So now there's a high probability that pullback is now over, and now we can target the week high, right? That's the general idea of what we're doing. Now, of course, there's a lot of other stuff that can happen in between. We can look for continuations from within here. We can look for counter trend moves, but that's sort of the bread and butter stuff of what we're trying to do, okay? Sort of another brief example where, again, it gets a bit more complex, where we can get complex ranges, and especially if you're taking more of that day trading approach, where we have this 4-hour range here, right? Break of structure. We've come deeper into 4-hour supply, so we can look to play that swing pullback into 4-hour demand, right? To then potentially look for the move to go. So imagine this is our higher time frame. So when we're trading here, we would then follow the M15. We would look for the M15 to switch bearish, right? And we would look for that to stay bearish into the 4-hour POI. And then if markets were nice and easy, like sometimes they can be, but rarely are, price would then mitigate our higher time frame zone. Our medium time frame, the M15, would then switch bullish, right? And then we would hopefully follow the M15 strong lows until it takes out the high. But as you're about to see, it can get a little bit more tricky than that in reality. And then eventually we come in, and then that happens, and then eventually we go, okay? So 4-hour would then be our higher time frame. So then if we drop down to the M15, again, I'm not going to go through this in exact detail now, but just to give you a rough idea of how markets can move, which I'm sure some of you are aware, right? We come into, or we get that break of structure. So down here is our M15 swing low. It's quite a big range. We get an internal pullback. We just change color of this. All right, we mitigate our extreme refined M15 POI within our 4-hour POI. Now, technically at that time, you could drop down to your execution time frame, say the M5 or the M1, and look for entries. But probably with a lot of momentum and everything, it can just be best to be patient, right? In this instance, you could wait for an IBOS, right? So again, not going to go into too much detail, as tempting as it is, but we get a reaction from demand, we push up and we push down. So now we have a big flip. But more importantly, the structure is bearish, right? The internal structure for the M15. So now you have a strong high and you have a weak low, right? So price pulls back up, we can look to short. As soon as price comes into our M15 POI, drop down into the M1, right? And then from within here, there'll be M15 POIs that can form. And each time you can look for entries on the M1 to try and follow that order flow to do what? To target that weak low, right? Then we get another M15 boss, but where have we come into? We've come into a refined M15 POI within the 4-hour demand, right? So remember the higher time frame objective, it could have now pulled back, and now the 4-hour chart may be ready to make that higher high. So what do we expect? Then we expect that the M15 internal structure can potentially shift bullish, which is what ends up happening, right? So you can look for M1 entries from within here, right? And we get M1 entries within these POIs, right? All of these, there's little, order flow within here, M1 entry, right? Break of structure, M15 POI, M1 entry. Not saying you should take all of these or that high probability, that's what we'll get into, but it's the general idea of what we're doing, the direction and the order flow and the higher time frame philosophy of what it is. So then we get that bullish IBOS, right? So now the internal structure is aligned. This is now a strong low. We come into old supply. What is old supply? It should just be reaction points for pullbacks. So as soon as we have our medium time frame mitigation, our M15 POI, what can we do? We can jump into the M1 and look for shorts to play that pullback, right? Again, we can play this whole move. Look for shorts from within here. As soon as price comes in, jump in the M1. Now we come into demand near the strong low. Now what can we do? Now we can look for longs, right? Or wait for M15 to give a bullish chop, come in here, look for longs on the M1, come up, look for longs on the M1, right? As soon as we come back into that M15 POI, right? Then we take out the weak high and we pull back again into demand. Look for longs on the M1, right? Mess around, try to break the highs, sweep liquidity. We're at least expecting an M15 pullback now, right? Again, screw out, and I'm going a little bit quick here, but I don't want to kind of get too stuck in the detail here. But again, we have that internal structure, we sweep, bearish structure here, M15 POI, jump in on the M1, come down, up to M15 POI, jump down to the M1. We're just playing the pullback. We'd expect that low to hold. It doesn't. Well, as we get into liquidity concepts, you'll see as we see all these sweeps, external range liquidity and all that fun stuff, we have reason to believe this low may now go, which it ends up doing. We now get a bearish IBOS, okay? So now this becomes a strong high. We'll look for price to pull back up into our M15 supply zones, jump into the M1, right? Look for shorts, price pulls back into M15 supply, jump into the M1, target the weak low. We get a break of the low, okay, but we're coming back down into 4-hour demand. So again, there's an increased probability the 4-hour could take over and we could switch bullish. The internal M15 internal structure does try to shift bullish. Old supply becomes reaction points for pullbacks. Again, we can look for shorts in the M1. Perhaps we can get long on the M1 here, right, to try and get the continuation. It ends up failing. We are in a big messy range at this point. Again, not getting too lost in detail. We then shift bearish again. So this then becomes technically a strong high, but where are we on the higher time frames? Remember, the higher time frame is king. We've now pulled, deeper into that 4-hour POI, right? Refine M15 within here, look for M1 entries. Come in, flip M15 demand, look for M1 entries, right? You can even look to play the short from within there, right? Depends on how active you want to get, right? Back into M15 demand, M1 entries, back into M15 demand, M1 entries, right? You could even be aggressive within this level, look for shorts from within here, demand holds, flip supply, back into here, look for M1 entries, right? It's not saying, again, none of this is, you shouldn't just be trading every M15 POI. There's going to be a lot to this, right? And this is a particularly advanced and tricky piece of price action, but it's just showing you the kind of, I'm trying to keep it to that kind of high level framework of higher time frame idea, right? Pull back into here. It doesn't always just happen smoothly, and then we go. But that whole time, whilst that's in the back of my mind of what's going on, I'm trying to use the M15 structure as like sort of my immediate bias. So we're within this bearish range, kind of want to focus on shorts from supply, but that doesn't mean you can't look for longs from within here. It's just they might not be as high probability. Then when we get short from within here and we start moving down, target the weak low, right? Come into here, you can look for longs in case that's the movement, so on and so forth. So it's M15 ideas, M15 POIs, lower time frame execution, but being aware of the bigger picture of the higher time frame will more often than not help you to understand how the M15 or your medium time frame is going to behave. But yeah, we will really dive into that, all of that really slowly. Okay, I've deliberately kind of gone over this at a quick pace, but it's just so you can kind of, like I keep saying, have that kind of high level grasp of the general philosophy of what it is we're trying to do before we now go and dive deep into the source. Liquidity. All right. So some of you may remember this diagram from the start of the technical analysis module. And I'm not going to go on a big rant about this, but essentially this is where I was trying to preach to you that my belief is market structure is king, or at least with the way that we trade. It's what you need to nail first. You need to have a very, very good understanding of it, because that is the bare bones skeleton of our framework, of our strategy. And we need to have that completely solid first. We build that solid foundation, and then everything else, all of the other concepts, we kind of layer on top and we go from there. So, whenever I'm looking at a chart, whether it's a blank chart or whatever, the very, very, very first thing I'm doing is thinking about structure, right? I'm mapping from the higher time frames, my swing high and my swing low, then the internal, then the fractal, whatever, right? And you work your way down the time frame. So you're always starting with structure. Once you have your structural ranges in place, then what do you do next? Then you add in those supply and demand zones, right? Within the current swing range. And that's what we've added in next, okay? So hopefully by now, okay, you don't have to have those mastered, but hopefully you've got a somewhat decent grasp of both structure and then how we integrate supply and demand onto and within our structure. And now obviously what we're going to be looking at, right, is liquidity. So liquidity, it can be a concept that can, again, probably be a little bit overwhelming, particularly when you go into it. You can get a little bit lost in the source with this. It can get a bit technical at times. It can be a bit subjective at times, depending on sort of how you view it and how you use it. The theory behind some of it can get a bit wishy-washy. So I'm going to try and do my best to kind of add in layer by layer by layer, and we'll build it up. And then hopefully by the end, my goal is to, because this is what my goal is with my own trading, is to introduce it in a way that is as mechanical as possible, so we know exactly why we're using it and how we're using it, to essentially just improve our edge that bit more. And kind of the main way in which we use liquidity is to help us refine the POIs, so those supply and demand zones we're trading from, and that's pretty much it. So it's knowing, it's just another filter, right? It helps us to know which supply and demand zone to trade from and what to look and wait for with our entry models when price is there. Okay. Once we then nailed all three of those, then we'll start to again really dive deep into those entries and then eventually management. Okay. But this is the order in which we need to have sort of those things, learn. And again, I'll just end it on this. Whenever you have your price chart and you're not sure where to start, or you've got lost, just delete everything, start with the structure, know what range you're in, add in your supply and demand, then use your liquidity concepts to refine those POIs and to know what you want to wait for when price gets there. Liquidity concepts will help with that. And of course, that then leads you into your entries. And then once you're entered, then you can think about management, right? That's the order in which we do things. So liquidity is essentially, like I said, it's a concept that can get a little bit, unnecessarily overcomplicated. So we're going to try and keep it somewhat simple for our purposes in the market, okay? When we start to talk about what it is, why it is, and how it happens, we're going to keep it somewhat simple to just, have a theory to hold on to, okay? So market liquidity is essentially the amount of demand and supply there is in a market. So it's like the amount of orders, the amount of volume. And the most simple way to think about it is how much money is there at every price level. There's a lot of money at every price level. There's tons of people wanting to trade at every price level. Then there's a lot of liquidity, right? So another definition is the ease to which a market can be bought and sold without affecting its price. So what that essentially means is if a market is very liquid, then buying and selling activity, it's not going to have much of an impact on price movement, right? Because price volatility will be very low because there's people trading at every single level. So it's going to take a lot of money to move price a lot because there's people wanting to buy at every price level, right? So then if you think about the opposite case, which would be a illiquid market, so that's the opposite of liquid, illiquid, this means there is low liquidity. So then buying and selling activity, trading, it will have a much higher impact on the movement of price, right? So price volatility is going to be a lot higher when it's an illiquid market because there's not a lot of people trading at each price level. So price has to move a far distance to find where the next buyer or seller is, right? So that's what you'll see in illiquid markets like penny stocks, or if any of you have traded altcoins and crypto, some of the really low market cap coins, they will move a lot when big orders are placed in the market. Even the housing market to some degree is pretty illiquid. So the diagram here, this illustrates what liquidity looks like in terms of an order book in the market, okay? So each of those lines, each of the red line and the green lines, they represent a price level in the market. So you can even think of each of those lines as being a pip. So like 1.112, 1.113, etc., etc. So if a market is very liquid, like it is on the left, then there will be bids and offers at every price level, but also there will be a large amount of volume at each of those levels. So you can see that by the money there, right? 5 million at each price level. So it's a massive amount of supply and demand at each price level. That's what a very liquid market would look like. So if you've ever clicked buy or sell with a market order on, say, euro dollar via your broker, so you just click buy and it will get you in the market straight away, you will pretty much instantly get filled at that current level. And the reason why is because it's an extremely liquid market. There will pretty much always be enough liquidity on the other side of your order to instantly fill your trade, right? Especially if you're a retail trader and you're not trading tens and tens of millions, you're pretty much going to get filled straight away on a very liquid instrument like euro dollar. However, with illiquid markets on the right-hand side, there may not be any bids or offers at certain price levels, and or the quantity, so the amount of volume of supply and demand at each of those levels might be a lot lower too. So that diagram on the right, you can see some of those gray dotted lines just to show that there's no volume at that price level. There's no one with an order there. No one wants to sell or buy at those gray dotted lines. And you can see the numbers, so 500,000 is a lot lower than 5 million, right? So there's a lot less supply and demand in that market. So like I was saying, a typical example of an illiquid market would be the housing market, right? So if you put your house up for sale, there's not going to instantly be someone immediately outside your front door ready to buy with your exact asking amount in cash, right? That doesn't happen. Whereas in the FX market or in a liquid market, when you click sell, generally there's going to be an instant buy and you get matched straight away. So in the FX market, if there was illiquid market conditions, this is where you will often see price gapping and moving aggressively to fill the next best available order. So this is kind of a key thing to think about. For every buy order in the market to be filled, there must be, it must be matched with an equivalent sell order, and vice versa. For every sell order in the market to be filled, it must be matched with an equivalent buy order for a trade to occur. So that sentence is super important for you to understand the concept of inducement, which we're going to look at later in this module. So I'm going to repeat that sentence. For every buy order, there must be an equivalent sell order for a trade to take place. And for every sell order, there must be an equivalent buy order for a trade to take place. Okay? Because otherwise no trade can take place. If you want to buy at, say, the price was $2 and you want to buy at $2, if no one's selling at $2, then how can you buy it? There's no one to sell to you. So if you're buying and there's no one at $2, then there might be a seller at $2.20, and that's where you're going to have to go up and buy, okay? So if there's no seller, then you can't have a buyer until you both agree on a price, right? Pretty basic stuff, but this will help you to really understand some of the concepts later, because that some people kind of sometimes struggle to get your head around. So this diagram shows an illiquid market. So remember, each line represents a price level in the market, and at each price level, there is an amount of resting orders, so resting liquidity ready to be filled. So if you were trading this illiquid market and you placed a market buy order of $700,000, right? So you're entering the market at the current market price. And remember, when we buy at the ask price. Okay, so we have to buy at the ask, and that ask is the first red line there. We cross the spread and we have to buy at the ask. But if we are looking to buy $700,000 of whatever instrument this is, but there's only $500,000 at the current ask price level, what do you think is going to happen? Well, if you press buy for 700,000, you would instantly absorb all of the liquidity at that nearest ask price, and price would continue to shoot up another 5 price points until all of your demand had been absorbed by the available supply in the market. Because you're buying $700,000 worth of this asset, but there was only $500,000 worth of volume being sold at that current price. So you instantly get filled 500,000 at that price level that you wanted, but to fill the remaining $200,000 worth of your order, price has to keep moving up and up and up and up, right? Until it finds that remaining $200,000 worth of orders. And that's where we end up there at the top of that price level. So price is constantly seeking liquidity to rebalance price. So when we see those large imbalances between supply and demand in the market, remember this is what we've been doing the whole way through the supply and demand module, where we've been looking at those zones on our price chart so far. That's what's happening, right? We are viewing this process on the order book via the price action, via candlesticks. Because when prices move by that imbalance between supply and demand, it will then keep moving to seek liquidity to then rebalance price at what it deems to be a fair value. So that's why you see the market move impulsively in one direction, whilst it seeks that liquidity to rebalance price. And then you see the market move correctively. It moves sideways until another imbalance is created, right? When those large orders step into the market that then break price out of that range, and then price starts rapidly moving to another direction. And then what is it doing? It's seeking more liquidity, more orders, more money in the market until it's rebalanced again, until supply and demand kind of even each other out for a little while, right? And then we'll see that corrective sideways movement whilst the market deems it to be at fair value. That is the heartbeat of the market. So the aim of the game that we are playing by using technical analysis is essentially using all of these concepts as a mechanical framework to read what is happening on that order book. But we don't have an order book, right? So how do we do it? We do it with the price action on our candlestick charts, okay? So again, we're using technical analysis tools, the tools that we use to try and read what that order book might look like, but we're just doing it with our candlestick charts. So we spent ages looking at market structure. And what is the purpose of using market structure? Well, we use it to help us with direction. So whether price is bullish or bearish. We use it to see if we are trading with or against the trend. And then how that all fits together within the multi-time frame story, right? When we build that higher time frame narrative from the daily, the 4 hour, the M15, et cetera, how that all pieces together. We also use market structure to see how well something is priced within the range, right? So we use premium and discount. Then we looked at how we can use supply and demand zones. And what does this do? This shows us where potentially large orders have entered the market, because that's where we see price causing those huge imbalances that rapidly shift price to make it move in one direction. And therefore, when we draw those zones on, that signals that potentially there may be some orders left sitting there. So then we can use that to our advantage when price returns to those zones, right? So a simple way to think about supply and demand zones, it's just to think about where did big money step into the market, right? We're looking for those footprints of institutional money on the chart. And that's what those supply and demand zones show, where those big imbalances in price occurred. So now the next tool we're going to be adding to our arsenal of weapons is to help us identify where large pools of orders may be sitting in the market and where price may gravitate and move towards. And that's using liquidity concepts, okay? So we're gonna hop on the charts and it'll be a bit easier to visualize, but if you literally think of that supply and demand zone, right, the way we looked at it, price is ranging, and then price breaks out of it to the upside and starts rapidly moving in one direction, what that is doing is it's then searching for where the next level of supply and demand is gonna be, right? Where those pools of orders are gonna be, and liquidity concepts are a way in which we're gonna be able to sort of anticipate that, okay? So liquidity in the market, you can kind of think about it as acting as a magnet for price to be attracted to, okay? It will start moving in the direction of where the next big pool of liquidity is going to be, because after those huge shifts in supply and demand that have caused those imbalances in the market, price is then constantly seeking the next available liquidity pool to tap into all of those orders to rebalance price, right? To make supply and demand more equal again. It kind of helps to think about it that way. And then it will tap into that liquidity pool, and that will provide the fuel for the next market move in whatever direction that's going to be, okay? So identifying liquidity in the market, it can obviously be a very useful tool for us to use in our analysis. But if we're not looking directly at that order book, right, that we just looked at, then how can we spot where there is liquidity lying in the market on our price charts? So that's what we're going to look at next to kind of see, how we can hypothesize where those resting pools are going to be. Alrighty, so we started to cover the sort of basic theory behind liquidity and how we're going to think about it within our trading. And a sort of super and crude quick recap of the previous lesson is that, essentially when you're looking at your price chart and you've got all of, every single price level over here, in a liquid market, at every single price point, literally every single micro pip, there's going to be a ton of supply and demand. There's going to be a ton of volume. There's going to be a lot of market participants ready to trade and transact at every level. So when you have a high amount of liquidity, it takes a ton of volume in order for price to actually move and absorb all of those orders, right? Whereas if there was an illiquid market where there weren't a lot of orders and it was a bit more a bit more bare, then if a big market participant starts buying in here, he's going to quickly absorb all of that supply, right, until he gets filled all the way up here, okay? So liquidity is essentially where we are going to be looking for, I'll explain this in a lot more detail as we go on in the other lessons, but it's essentially where, if you're a big player, right, you're going to need a lot of liquidity to enter and exit the market without minimal slippage. You're going to want to be looking for those points in the market where there are a ton of orders. We don't have view of the order book. Okay, and also FX is OTC, over the counter, right? There's no central exchange. So how do we do it? How do we read it? We read it through the price action on our charts. Okay, so same way with supply and demand, we're not looking at the order book. We are looking at where those orders came into the market that did something significant, right? Broke structure, or ones that, flipped another zone like that, right? Then that's a strong supply zone. And then we can have some general assumption that within this level here, because it managed to overpower supply or because it broke some structure, that these two zones could have a lot of orders within them, right? Where price may tap into it, fill those orders and continue the move. So that's what we've done with supply and demand. Liquidity is another thing where we're going to be trying to identify on our charts, identify where those resting pools of orders may be. Because if you're a big player, right? An institution, BFIs, as people like to call it in the space, banks, financial institutions. Let's just continue with that term because it's nice and easy, right? If you're a BFI, generally you're going to be you are generally going to be wanting to exit and entering the market where those pools of liquidity are, okay? So essentially, before we get lost in all the sauce with these next lessons you're about to dive into, because it can be very easy to get lost in this, okay, as we go through this, especially if it's your first sort of time, we can get really lost in detail here. But if you always try and remind yourself every time you're thinking about liquidity, it's just another tool we're using to try and identify where there may have been BFI involvement, okay, where big money may have been getting involved, right? And remember, the whole kind of general philosophy of our trading is to try and spot their footprints and to use that to our advantage to kind of, be trading with them rather than against them, okay? That's kind of my philosophy of what I believe I'm trying to do here. So this lesson is supposed to be relatively simple and give you the bare bones of the sort of minimum I'm looking for in the market to identify where, we make a general assumption that liquidity will be. So as you can see here, right, bare minimum, we just have a high like that, right? A pivot point in price. So on a candlestick chart, that's what I would need to see, right? So the same way we look at fractal structure, where, each candle breaks the previous candle's high, and then as soon as the next candle fails to breach that candle's high, we've had that pivot in price, right? We've had that pullback. That is now a high in the market, and we can assume that some liquidity, there'll be untapped liquidity above that high, right? Because what's happened is you've got orders all here in the market, and as these candles move up, what are they doing? They're filling that order. They've filled all of that supply, right? They filled all of that supply, and then they come up to here, and then this order now hasn't been tapped into, right? And then prices started trading back down, and it's filling all of the demand that was left here, right? So this untapped order, or the amount of, to be more accurate, the amount of supply that has not now been used, that is resting liquidity, right? Sitting above that high here, right? So that's why we then use, or if you do it like me, I just use a line with a little X on it just to show resting liquidity there, or we assume there is resting liquidity, okay? And that's the bare minimum. And then the same thing for a low, right? So you get that pivot in price. You would have all of this demand here, right? Price is trading through it. It's absorbing all of that demand. It uses all of those orders up. And then at some point, price will pull back. So now you have those untapped orders down here, right? These have not been tapped into. These have all been taken. And now we assume there is resting liquidity below that low, okay? And then everything just stems from that pattern, either a low or a high, and then you can just build it from then on, okay? But it's just basically wherever you see a low or a high, we can assume there is some liquidity. Now, how much liquidity we can assume is resting there, we can get into a bit more in the following lessons, right? And we'll look for things like this, okay? I'll touch on it now, like where if you just have a high like this, okay, maybe it's a weak high, it didn't break any structure, there might be some liquidity behind it. Whereas if you have a high that actually achieves something significant, there could be a lot more liquidity, or we can assume there may be a lot more liquidity behind that high because a much more significant thing has now happened in the market, okay? And what do you think is going to happen for people who are trading this, right? So if someone's already short, where are they going to have their stop loss? They're going to have their stop loss behind that high, okay? Now, if you are short and your stop loss is behind there, what order is your stop loss in the market, right? If you've sold and then price stops you out, what do you have to do to exit your position? You have to buy, right? So when you're short, your stop loss is a buy order, okay? So when you see a high like this, that's broken structure, we can assume there's probably been a lot of market participants who have sold, right? Or what else may happen? When price comes back up, okay, people might want to sell the double top, right? And that's when you'll get patterns like this. So then that can mean there's even more people selling now, right? And there's more stop losses behind here, which means there's more buy orders, right? There's buy side liquidity building up behind highs, okay? Because again, if price comes up and you get stopped out and you've sold, what do you need to do? You need to buy back your position. Now, what's the other thing that can happen when you get this is you can get breakout traders, right? They see that seems like a strong level. If price breaks that, we're probably going to go to the moon. So they want to buy. Or some of you may know bull flag patterns, right? Where you get an impulse correction. And then the next idea is that you get that next impulse. What are people going to do? They're going to buy that, right? So what do you get? More buy side liquidity. So, okay, so whether you've shorted or you're buying, it's a lot of buy side liquidity above those highs, okay? And that's what we assume builds. It's the same with the trend line, okay? Or whatever way you want to do it, kind of a retail pattern. Price comes in for the touch, gets short, or 2 touches confirms the trend line. What do you learn on YouTube? Okay, let's sell the 3rd touch and let's get short, right? Or even if you're a supply and demand trader, like we are, right? Break of structure, come into supply. What do? We look to sell, right? And then stop losses can be above the high. And again here, we can look to get short, more stop losses can build, right? So this whole time, what's happening? Buy side liquidity is building up behind those highs. Okay, my stop loss is a buy order to buy back my position. And then the exact opposite for the lows, right? Let's just do one or two examples just to speed this up a bit. But yeah, we have a support floor. If you're long, where's your stop loss going to be? It's going to be below. And your stop loss in this case is going to be a sell order, right? Because if you bought to get long, if price then stops you out, what do you need to do? You need to sell your position back to the market, right? So that's a sell order. Again, if you buy all of these lows, what happens? Tons of sell side liquidity starts to build up below those lows there, okay? So we get what we call sell side liquidity below the lows and buy side liquidity above the highs, okay? Now the importance of this, it will come later in terms of how we actually use it to formulate trade ideas and use it within our trade plan and our strategy and our entry models and all of that fun stuff we will get into. So for now, I kind of just want to get your head around the sort of basics, how we, basically what I want to do now with you is get very clear on what our definitions are, okay? Especially when we look at sweep zones, we'll look at the things individually. And then as we go through, we're going to start to put all of the pieces of the puzzle together again. And that's when we might get lost in the sauce a little bit, right? So let's try and build up slowly and we'll get there. But let's just now go have a look on the charts at some sort of basic liquidity identification. Alrighty, so now we're going to actually look at a real chart. How do we identify where there is resting liquidity in the markets? Where are those resting orders? That untapped money that may be sitting there? Well, remember the bare minimum definition of where I will start to or anticipate that there is liquidity sitting below the market is when you actually have a low, right? A fractal high or low. So I won't be drawing on this time frame liquidity below the low of the candle. It needs to be this actual low here, okay? So again, I wouldn't draw the liquidity below that bearish candle because price is already tapped into it. It's not a structural low. This is where the low is. Likewise, that's where the high is. There's liquidity behind there. There was liquidity behind there. Just zoom out, right? That's the structural high. We move down, liquidity gets left behind there. There's untapped orders behind that structural high, and then price moves into those liquidity pools, okay? So this is, or what I'm gonna do in this lesson is not really anything that systematic or that you're gonna be directly sort of implementing into your trading or trade plan. This is just kind of gonna be a very loose way of just scrolling through the charts, showing you where liquidity is and kind of just getting your eye for it. And like I said, as we go through the next lessons, that's when you'll learn okay, how do we actually now implement this and make it as a tangible piece of the systematic framework that I use and put it into your trade plan, right? So without kind of even drawing on structure and supply and demand zones, you can just zoom out and you can see what's going on here, right? Like we have, all of these relatively equal highs building along here. So we almost get that support level, right? People selling every time we come up here. Again, support and resistance traders going to be getting short. Tons of liquidity is building up here. And eventually we get that aggressive breakout to the upside as all of that buy side liquidity is tapped into. And then we get that aggressive retrace to the downside. And if you zoom in and kind of take that move apart a little bit within here, what do we have? We have that ascending trend line, right? That trend line liquidity building below those lows. So we know there's a ton of resting sell side liquidity below there, a bit of a mouthful, and then price comes down and taps into those orders. Then we've got relatively equal lows here, right? Another support level. What do we know? There's resting orders below there. So then when price comes all the way below there, again we get another bounce here, just generating even more liquidity. We get that triple bottom, people getting long, have their stop losses below those lows, and then price taps into that orders, it rebalances price, and then we get the pullback, right? So that's why we say every time we have a break of structure, what do we typically expect? We expect the pullback as that resting liquidity is then tapped into, right? Same thing again here, start to build a bit of a range. We get sort of these triple bottom lows, tons of liquidity starts to build below that, and then eventually we get the breakout of that. Then what do we leave? We leave these equal highs here, tons of buy side liquidity is left above there, right? And eventually price will come up into there, and as price takes out those highs, just tap into it, right? Belly doesn't have to be a big tap, just enough, and then we start to see a bit of sensitivity as that buy side liquidity is tapped into. Even on a more granular level, if you really zoom into price, let's take a look. What do we get? Or even down here, right? We get that ascending trend line, people buying that trend line high, and then we get liquidity resting below that. Now, just because liquidity is there, we never know when it will be used, when price will tap into it. We just know that it exists, and at some point it may be used in the future, because as we can see, right, the trend continues to the upside. We have a fractal low here. So yes, that to me would be liquidity sitting below that low. As we can see, as soon as price just trades just below that, we get a sweep and then we move to the upside. Resting liquidity above that high, what do we get? We get a sweep and then we pull to the downside. Then we get a sweep of the resting liquidity below the most recent low, right? And then that fuels the move to the upside, right? So we'll talk about this a lot more in near future lessons, where we talk about sweeps of liquidity and how that can, generate the continued moves. But essentially, when you see highs and lows like this, especially when they're kind of near each other, you can see you have that boxed off range. So people selling the breakout of their range, they get short. What happens? They get smashed as price trades back into the market. Likewise, people buying the break of this high here, if they got just tapped in trying to buy that, price trades in. So you get a lot of manipulation when that can happen. Likewise, price comes up here, we get a bit of a pullback, we move up, we fail to break the high. So this is a good example of relatively equal highs, okay? It doesn't have to be like a perfect double top, but you can see there's a clear move up and a clear move away, right? So you've got those relatively equal highs. This is kind of how I personally would annotate in the market. You can just leave a line there with a little X in it. Typically what I'll do, if I can be bothered to do it or if I remember to do it, when I'm marking up my charts, is I'll just do that to show that the liquidity hasn't been tapped into. And then when price does move up and tap into it, that's when, again, if I can remember or be bothered, I'll put it in the middle to kind of show that the liquidity has been taken. Likewise, we can see price then comes back down, sweeps the resting liquidity below that low, and then we get a movement to the upside, right? Then price starts to pull back, we start to build that descending trend line liquidity, starts to build up here, price then comes in, takes the liquidity above the high as well, fills up those orders, and then we get the pullback. And what did that move leave? It left relatively equal lows behind here, right? So we've got resting liquidity there, price then comes down. Price then comes and sweeps liquidity below this low, right? I think you guys get the drill. There's liquidity everywhere constantly as price is searching for those pools of liquidity, searching for those untapped orders to fill up, rebalance price, and then fuel the move, fuel the next move that's going to occur from there. So again, relatively equal lows down here, relatively equal highs to the upside. Price comes in, taps those orders, and then it fuels the move to the downside. Grab the orders below here, right? And then it fuels the move to the upside. But this is, as you notice, that's when we get the shift in structure. This becomes our strong high. We come into supply, right? We grab the orders and then we target the liquidity below that weak low. Okay, so we can start to bring in our other concepts, and you can understand now how they all start to move together as we come in. We then get a break of structure. It taps into that liquidity below the low, fills up that sell side liquidity, right? And then buyers start to step into the market to push price back up. That's when we start to get sweeps of these internal highs, right, to then fuel the next move to the downside. Again, targeting the liquidity below that weak low to rebalance price. Price then starts to pull back again. Okay, so once you kind of start to see this, these same patterns happen again and again and again. Right, we start to pull back. We start to grab the liquidity behind the highs until we eventually, fill up enough of those orders to rebalance price to then get that overwhelming imbalance between supply and demand, where supply starts to regain control, and then we start tapping into all of the sell side liquidity, and eventually the sell side liquidity below that swing low there, the external range liquidity. Again, this is concepts we'll talk about more in the future. I'm kind of being quite loose here, as I said it would be, just to kind of keep it relatively simple, but just showing you what those pools of liquidity are. Again, you can see relatively equal highs there. What does price do? It comes up and grabs the orders that that pool of liquidity that would have been sitting there, if you think about it as money, grabs that fuel, and that can fuel the move to the downside to target this weak low here, where again there'll be liquidity sitting below that low. You can see even just before it gets there, nice double bottom, inducing buyers into the market, more stop losses getting below here, taps into that liquidity, and then we get the movement again to the upside. And then this whole time, what do we have? That larger trend line building up, so people can keep selling that, and eventually with that big trend line, what do we know? There'll be tons of resting buy side liquidity here, which the market then comes in and grabs, and then that fuels the next move to the downside, right? So yeah, I mean, even if you zoom out and do multi-time frame analysis, you'll be able to see loads of other things. You can even see here, right, without zooming in, we get this big range for a long time. Or do we know there'll be a ton of resting liquidity either side of that range as it's building up? So you'll get a bigger double top like that, price grabs the liquidity and then fuels the move to the downside. What do we have? The big trend line liquidity, the bottom of the range. We just know there'll be a ton of orders building below that, and then price grabs that, grabs the liquidity below the low there, right? Taps into that pool, retraces again. Even within all of that range, again, there'll be sweeps within that. right? All of these highs within here. You even get the exact high of the range. As soon as that pool's swept into, what do we get? Aggressive retrace back inside the range. Liquidity sweep here, right? Taps into those orders, retraces back inside the range. Get a massive double top there, right? Loads of people who are short, where the stop loss is most likely going to be from these highs. Or breakout traders wanting to buy that level because they think it's such a strong level with such a big movement away. They try and get long, and then both people who got short get stopped out, people who get long, they get tagged in and then stopped out. All that manipulation to then fuel the move there to the downside. Okay, so I'm not going to do any more than that because I think you guys probably get the idea of what I'm getting at here. But kind of just wanted to show you the bare minimum of where we anticipate liquidity being, within the market. Essentially looking for those untapped highs and lows in the market. And now over the course of the lessons, we're going to learn how we actually kind of put together a more systematic and mechanical framework for what we look for to add to our trade plan, namely sweep zones and inducement. So yeah, let's dive into those in the next lessons. Okay, so we've looked at what liquidity is, and then we started to look at how we can identify where we assume resting liquidity is on the chart, or where liquidity was and has already been swept and taken. Okay, so now we're going to start to get into the more sort of juicy side of things, where we are going to look at how we actually use these liquidity concepts within our trade plan and how to formulate trade ideas and all that good stuff. So like I was saying before, first we're going to kind of have to strip things down into their individual pieces, into the individual components, so we just know how to identify them and what each individual component, how we interpret it. And then as we go out through the lessons, then we're going to put those all together to put the pieces of the puzzle together right, and we're going to get a bit fancy and then perhaps a little bit lost in the sauce with entry models and all that good stuff. So it's good to just take our time, build things up slowly, and we'll get there. So yeah, and like I kind of touched on there, it can be very easy with all of this, and not just liquidity concepts, but the whole strategy in general. There can be a lot of variables, a lot of components, right? And it can be very lost to kind of, or very easy to get lost in all the source of it. So what I always try and do is trying to bring things back to a high level and ask ourselves is, what are we trying to do here? What is kind of the overarching philosophy of the strategy and the trade plan? And for me, what I think I'm at least doing, or what the philosophy is behind my trading approach, is to look for institutional footprints in the market. Okay, so where was the big money involvement? It's a bit of an oversimplification when I say the big money involvement, but it's just an easy way, I think, to kind of hold on to what it is we're trying to do here, right? We're trying to look for where the big guys got involved. I want to be trading with them rather than against them, quote unquote. So the first kind of way we've been doing that, specifically with sort of looking where they've entered, is looking at supply and demand zones, but not just any supply and demand zone. We want to look for where did big money enter or exit the market to cause those overwhelming imbalances in the market, right? So to significantly move price. How do we do that? Well, we filter those supply and demand zones by looking at ones that either broke structure, right? Because obviously it takes a significant amount of money to break structure. The more significant the structure, the more significant potentially that zone is going to be, or it managed to flip another strong zone, right? Where we see that interaction between supply and demand, and one manages to overpower the other, right? Where one takes control, okay? So when we've been identifying that, that can hopefully signal that there was institutional backing in the creation of that zone, okay? So liquidity concepts, they're simply just another great filter to signal BFI involvement, okay? BFI, banks, financial institutions, right? It's just another acronym in the space that's already overloaded with acronyms, but basically the big guys, right? Institutional involvement is what we're saying there. So it's just another way in which we can now apply these liquidity concepts to what we've already been looking at as another sort of tick in the box. Let's say that potentially there was big money involved in that area, okay? So now just bringing a step back to what we're talking about in the theory lesson, right? Every buy order must have an equivalent sell order for a trade to take place, okay? So obviously, like I said, if you need to buy 10 apples at $2, you need someone selling that minimum amount of apples. Someone needs to be selling at least 10 apples for $2, right? Otherwise, there can be no trade taking place, okay? So if you're a large market participant, right, you're going to need the equal and opposing liquidity to enter the market with minimal slippage, okay? So essentially what that means is, well, if you think about the order book, right, at every single price level, there's going to be, orders, right, supply and demand. And if you're in a market where, say, there isn't a lot of supply and demand and it's a bit of liquid, like you've got loads at this level, not much here, another chunk here, and then loads up here. If you're someone down here, right, and you're a big guy, let's say, and you want to buy 10,000 lots, what's going to happen? It's going to quickly absorb all of that supply, and you're probably going to get filled some of your order up here, okay? So large market participants, they need opposing liquidity to enter the market with minimal slippage, right? If you want to buy here with a ton of volume, you want a ton of volume to be exactly where you want to buy. You want a ton of volume to be selling to you that you can buy from, right? So you can transact at this level rather than getting filled all the way up here. That's essentially it. So when we are identifying where liquidity has already been taken, okay, so that's why we're looking on the price charts and we're going, okay, there was probably, if you got a low like this, right, there was probably liquidity below that low. If we see where price comes down and grabs the liquidity below that low, that's what we say grabs, liquidity has been taken, liquidity has been swept, liquidity has been run. They all essentially mean the same thing, that price has come in and grabbed some of those orders there. So when we say it's been taken in the past, and it leads to the creation of a supply and demand zone, that is what we call a sweep zone, okay? And that's the signals where BFIs have likely entered the market, right? And this is where we kind of get some of these patterns like this, okay? So essentially, we are looking for, in the creation of, well, let me bring it back again. When we look at supply and demand zone, like I said, right, we're just looking at one structure zones, ones that lead to a break of structure. Now, all we're simply doing is when we identify a zone, we validate it because it did break structure. Okay, so we know it's an institutional zone and it's an institutional structure zone. The only extra filter we're now looking for is we look left of the zone and we go, did it sweep any liquidity, right? And it swept the liquidity behind that high. So now we call it a sweep zone, okay? Because if you think about it, if an institution is selling here, right, and they're selling or they're shorting enough, right, to lead price to be able to break a low, that's what we identified, that potentially there was a lot of supply that came into the market, so then we can look to try and get short here, right? So we use the filter of it breaking structure. Now, like I said, for every buy order must have an equivalent sell order, okay? So if you're someone who wants to sell, a ton of volume up here, what do you need? You need someone buying, right, from you selling into. You need a lot of people buying up here. And what do we know about highs? We know there's a lot of buy-side liquidity above highs where people are either buying the breakout of a high or the breakout of a bull flag, or what's the other way? They could be having their stop loss behind the high, right? If they're short and price comes back up, what's their stop loss going to be? It's going to be a buy order, right? If you've sold your position and you're short, if you get stopped out, what do you need to do? You need to buy back your position. So essentially what we know is behind highs, there are tons of buy side liquidity, okay? There's lots of buy orders there. So if you're a big guy and you want to short and you want to sell, what do you need? You need that buy side liquidity. So it's likely you're going to enter short up here, selling into all of that buy side liquidity so you can get as much of your position filled as possible. And then that move leads to an overwhelming imbalance that causes a break of structure, okay? So it's just another filter that potentially signals there was institutional involvement in the creation of this supply zone because it led to a break of structure and it grabbed the liquidity or used the liquidity in order to enter the market, okay? That's the theory behind what we're doing here, okay? So yeah, essentially liquidity, identifying where liquidity has been taken in the creation of a sweep zone, signals where potentially they have likely entered the market, and where liquidity is resting, okay, so liquidity that hasn't yet been tapped into behind here. We'll talk about this later, but essentially that's the concept of inducement, and we can signal where they will likely in the future potentially enter the market, okay? So a sweep zone is a POI that sweeps liquidity as it is created, and we assume that it's likely there was institutional involvement in the creation of the POI as they grabbed the resting liquidity to enter the market, right? So another quick few examples. A point I want to make is how much, I think I alluded to this before, but how much liquidity is behind this high? We never really know, right? But we can look at certain structures and assume that some may have more than others. So if you think about this high here, right? If you've got a bullish market like this, what did this high achieve? It didn't achieve much, right? It didn't break any structure. It's just a weak high that had a pullback. So arguably there's not as much liquidity behind this high compared to what we have over here, right? Because what do we have here? We have price pullback, breaks the high, right? So this low did its job, right? It broke structure. So you could assume that because this low actually achieved something, it broke structure, there should be quite a decent amount of liquidity behind it. So now if price breaks that low there, right? You would assume there's even a ton more liquidity behind here now because it actually achieved, it broke a strong low. So now when price comes back up and sweeps liquidity behind here, the sweep of a strong high, so a high that actually achieved something, compared to the sweep of a high that didn't achieve anything, we can assume there'd be a lot more liquidity building up behind this high. So if you see a zone like this where it sweeps strong structure, strong high or low, right? So you got this low breaks the high, that then becomes a strong low. If price now comes down and grabs the sell side liquidity below that low, we can assume that this, in theory, this zone should be stronger than this zone, right? If everything else was the same, of course you have to bring in market structure, multi-time frame analysis and all that fun stuff. But if you just had two identical zones, but the only difference was this, in theory, this should be the stronger zone because it's used likely more liquidity behind that strong high. And then likewise, same here. If we have a build up of equal highs, we know there's going to be a lot more liquidity starting to build up behind there compared to if you just had, one weak high like that, okay? And that's pretty much it. You don't need to overcomplicate sweep zones any more than that. Kind of just a little sort of FAQ here. For me, for a sweep zone to be valid, it does not have to sweep strong structure, okay? So that's a weak low, right? If you have a trending market, it never broke the high, so that's a weak low. It doesn't have to sweep it, but this is obviously more ideal, right? Because this sweeps strong structure. So I would view this as higher probability than this, but it doesn't have to be. I would still view that as a sweep zone. Okay, and the other thing is the sweep must be vertically near the POI. So what I mean by that is like if you say you had a pullback like here, and then price comes all the way down, and then price comes all the way up and breaks this high, okay, that is a valid demand zone, right? That broke this high here. But can we say that it swept the liquidity behind this low? Well, it's miles away from me, right? So like, it's probably used liquidity all the way down here. So I wouldn't say that that's a sweep zone of this level, okay? It needs to be pretty near it. Now, the other thing as well that I forgot to mention is sort of when we look at this on the candlestick charts, it'll become a bit more obvious, but sweeps usually kind of, they have what I call the nature of price action. So what you'll typically see is price will kind of come up, it'll sort of be a bit slow, and it'll kind of just grab the liquidity behind the high, and you'll usually see like a big wick and then like a sharp movement down, okay? It's kind of like slow movement up, and then boom, like the big money steps in. And usually you'll just see kind of like a big wick like that, a big wick retrace, or you maybe see like kind of one or maybe two candles close and then like boom. So it's kind of like that obvious sort of sweeping nature that you get to it, okay? So yeah, that's it with structural sweep zones, and we'll take a bit of a look at these on the charts to identify them. So 20-second recap on what a sweep zone is. It's essentially another filter that we are using that potentially indicates that a supply or demand zone was created by institutional involvement, big money involvement, because the theory is that they've likely used the available sell side liquidity below that low to enter their long positions that then leads to that break of structure, or likewise using the buy side liquidity above those highs to use as liquidity to enter their short positions to enter the market. Okay, so let's go and look at what these look like on an actual chart. Did get some requests to look at pairs other than euro dollar, which is fair enough, right? Just to show you, how these concepts are universal and can be applied to any instrument or asset class. So let's kind of just zoom in to the recent PA price action. And what we're going to do is, like I said before, at this stage of this module, we're just going to be focusing on identifying and sort of defining those individual concepts on their own. So I'm just going to look at some examples of sweep zones. We'll talk a little bit about how it's developing with price action, but for the most part, I'm not going to be getting too stuck into how we're analyzing everything together with all of the concepts and thinking about trade ideas and forecasting where price is going to go. We'll leave that for a little bit later in the module. For now, I don't want all of these lessons to turn into 30 or 40 minute walkthroughs. I just want us to get good at identifying them, and then towards the end, right, we'll put it all together and we'll spend a lot more time kind of really walking through price slowly and using bar replay and all that fun stuff. So what we'll do is we'll kind of go from here and we'll go through sort of recent price examples to where we are. Now, one thing I'll say as well, I'll just zoom out on probably to the weekly chart on pound dollar, that when you get these sort of major breaks of monthly and weekly lows, right? And we can see that price ends up having these big pullbacks up towards a strong high. And then again, we get another big, massive, basically break of that low, and you get these sharp movements. Very often the sort of nearest structural high can be quite far away when you're trading down here. So like, for instance, it might be a bit more clear on the daily, like the last real sort of clear swing pullback is all the way up there. So for all of this time when price is trading here, yes, you know, you can look at that as your strong daily high, but typically what I would advise is just kind of focus on the more recent price action and like follow this, just because you've got such a massive swing range that, you know, if you're trying to short every supply here, a lot of times, you know, price is just going to react. It's just a catalyst for a pullback, right, to push up higher. Again, we'll talk about this a lot more when we come to internal and external range liquidity, but just because when I go through this, it will make a bit more sense as to why I'm going to start mapping structure, right, looking from within here. Even though, yes, I know that the last swing high is probably all the way up here. When you get these big, massive sell-offs, sweep of the low, I'm basically going to start mapping my internal structure from here and just focusing on this, because otherwise if you're just, you know, waiting to short from all of these supply zones, a lot of the time you are going to get smashed. So we kind of look down here and just start mapping that internal structure on the 4-hour chart. And we can see we had this break here. Now, what happened when we led to that break? Obviously, we have demand zones that came in to lead to that break of structure, but what do you notice? We have price come down, it pulls back up, right? And then it grabs the liquidity below that low, right? We get a sweep of liquidity, and then that fuels the move there to the upside. So let's just draw these on. Okay, and then it's quite a big candle, so it's a bit of a messy zone, but essentially you get that large sell to buy candle with the next candle closing above it, right? Price taps into that, and then that leads to the move that then breaks structure. And then even on a smaller scale here, you see what happens. Price comes in, it pulls back, it breaks the high, right? So we know there'll be liquidity below that low. And what does price do? It comes down, grabs the liquidity, and fuels the next move to the upside. So you have another sweep zone there. Okay. Bit of a tricky one this to draw, because sometimes when you get kind of price action like that, I kind of like to include the wick as well, and I kind of just take that whole range. We get a bit of a reaction, but it ultimately ends up failing, and we come a little bit lower. We end up tapping into the previous internal demand range here, as we can see, and then we continue there to the upside. But as we pull back, all right, so at this point, this would be your sort of larger internal high that you'll be focusing on at that time. What happens when we form the strong low? Well, as you can see, as we're pulling back, get that fractal structure, this low breaks the high. Okay, so we know that that becomes somewhat of a strong low because it actually broke some structure this low here. So we know that would be a fair amount of liquidity building below that low, sell side liquidity, right? Enticing early buyers into the market. Price then comes down, grabs that liquidity, and now it has the fuel to make that big move, right? So the theory would be that that low gets put into the market, enticing early buyers into the market, generating more sell side liquidity. And now let's say the big guys can step in and they can use that sell side liquidity to enter their long positions. And now there's enough juice to fuel that movement to the upside. Okay, so we get another sweep zone here where we sweep the lows there. And then we move to the upside. And as we can see within that overall move, we also get a flip. So we get the reaction from supply, and we can refine that to the pivot candle in which price comes down to, right? That's where demand really regained control from supply, and we move there to the upside. And even you can see here, right back here, when this initial sweep happens, then we flip, and then we come up, we have a bit of a pullback, and we go higher. And what happens? That generates more liquidity below that strong low, right? That broke that high, and then price comes down. We get even more equal lows here, right? Another bounce, just enticing more market participants into the market, generating more sell side liquidity. And then we get that liquidation into the flip here. And then now we have the fuel to make that movement to the upside, right? So you just get another big sweep POI here, right? And then eventually that leads to the move that breaks structure to the upside. And then again, we come down to this strong low here. So hopefully you can start to see a bit of a common theme when the pro sort of trend moves, pro order flow moves. Very often those strong lows when we're bullish will form through a sweep of liquidity. Okay, so like, I don't know why that disappeared. I must have moved or deleted it, but there, we initially had that sweep here, right? So very often what you'll see is price will move to the upside. You kind of get those corrective low resistance highs. Price will come down, and then as it's sort of starting to make that what we think is going to be the higher low, very often price will come down, then grab the liquidity, and now we have the fuel to the upside, and then we get the break of structure. And then likewise, we sort of get those corrective moves down. All right, we might build some equals, and we'll get a sweep of those potentially into the sweep POI here at the previous strong low. And then we'll have the fuel, right, as we liquidate those lows to get to the upside, right? And those low resistance highs there, that basically leaves liquidity to target, available liquidity to target at the high. And then same cycle repeats, right? We'll come down. Obviously, it can all happen in slightly different ways. You get a break of the high there, generate strong liquidity below that low. We come into the previous sweep zone, and then we go. So that's why, you know, when you've got sort of descending highs like that haven't swept any liquidity, that's where we say there's resting available liquidity above those highs there. It's low resistance. So when price is coming up, it's easy for price to target those highs, right? There's liquidity to target. But when price is pulling back down into our strong structural low, this is where we have that sort of high resistance liquidity low that formed, it swept liquidity. It's got strong demand zones that took liquidity that led to the break of structure. And that's why, we have those protected ranges, and very often price won't break it and will continue to the upside and target that low resistance available liquidity at the top, right? So you can see kind of what I'm saying here is we come up, we pull back, sweep liquidity, strong movement to the upside, right? Again, we have that pullback, get that low there, sweep liquidity, and then eventually we come up, generate more liquidity, sweep the liquidity, and then we go. And that will happen, even on a smaller scale. Like when we come into this low down here, right? That sweet POI that swept the liquidity below that low, we initially tap into it. It's a bit of a tricky one to see on this time frame, but we come in, what do? We move to the upside, and then price comes down, and it just grabs liquidity just below that low, it just breaks it by a few pips, right? And now the movement is ready to go, and you get another sweep zone created there. Now this one's even a bit more subtle to see. Do we flip this range? Yeah, we do. So we come into the supply, but what happens if you look at how those candles would have formed, right? Price reacts, it comes down, it pulls up, and then what does it do? It comes down and grabs the liquidity below that low. Yes, it's just a weak low, right? It didn't break any structure on this time frame. But remember, for sweep zones, we don't need it to sweep strong structure. It can sweep a low like that, and for me, that's still valid. I find it higher probability, and I prefer it when it sweeps a low that actually, clearly broke structure, and even with the candle body close, like that's brilliant when that happens. And you can see when price came back, super strong reaction. Okay, but for me, this still meets the criteria, and this is a flip that swept liquidity. So yeah, spoiler alert for the next lesson coming up, but this is a perfect example of that, right? So we had the reaction from supply, we pushed the upside, but what did the reaction do? It swept liquidity, okay? It came down, it came up, grabbed the liquidity below that low. So the theory is, right, it signals more institutional involvement using the liquidity that would have been available below that low to enter their long positions to then overpower supply and continue the movement. So what do you have? You have a flip that swept liquidity, okay? So now obviously you can draw your flip from the top of the reaction to the bottom of the reaction, which we come back into. Of course, you can refine it to the pivot zone as well. And again, rinse and repeat, right? What do we have? We try and take out the high at that point, right? That would be your range high. Zoom out a little bit, right? You can see the bullish structure forming overall, right? You can see this larger internal structure. We pull back, larger range here, right? So that would have been your low. Okay, so there was always potential, right? Price might have wanted to come down and mitigate something within that wick. But if you actually look, right, that's where liquidity was taken. That's where you had that true kind of last interaction between supply and demand. Then we got the sweep of all of this liquidity here, right? So we're following the money. That was the last big injection of demand. So although price could have come down to the strong low, there's pretty good reason to believe why this might be the next POI where the next swing low is going to form, right? To come to the upside. So we can look for 4-hour continuations within here, right? We can look on the lower time frames and try and get involved. And then we get that next interaction here that sweeps liquidity. So we know there's probably going to be somewhat of a protected low within that range. And then again, what happens? Entices early buyers into the market, they get liquidated, and then we come into that last level there, and then we go. Okay, so this is somewhat of a sweet POI. Again, it's a little bit far away. It's kind of what I was saying, right? In terms of, so if I draw it on first, to say whether or not you can classify this particular POI I'm drawing on now as an actual sweep zone, because obviously I'd like it to be pretty near like that. But yeah, it meets the general criteria, right? There was liquidity below there. Liquidity was potentially used in line with this demand, right? Using all of that sell side liquidity to enter long positions here to buy against those sellers to then generate that movement there to the upside. And obviously, when trending markets are strong, they're not always going to pull all the way back. Do we have any sweep zones in here? Let's have a look. So price comes in. We pull up, right? And then we come down. So we grab the liquidity below that low, and that fuels the movement there to the upside. Okay, so hopefully you can sort of see with your eyes now, what we're looking for. Some are obviously a lot more, let's say, significant than others, right? When we have like the big liquidations back here, following the demand chain into the flip, well priced, right? We can start to add in a lot more stuff, but kind of just at this point, like I said, just trying to like sort of identify the bare minimum definition of what one is. This one's a bit messy to sort of draw, right? But you do have, that's kind of being the cleanest zone. Price won't always come in and kind of perfectly mitigate that. Sometimes when you get sort of, quote unquote messy price action like this, I will obviously draw it on the nice refined pivot range like that. And I did, it's super nice when price perfectly mitigates that, but sometimes you can kind of read between the lines a little bit and like, I'd want to cover that wick. Some of you may even potentially want to take the larger range, right? But obviously as price pushes into the zone, you can refine it a little bit and then look on the lower time frames for your confirmations. And again, another sweep of that low as we came in to that POI, right? Now this movement here fails to break structure on this time frame. So this wouldn't, this here wouldn't be like a valid 4-hour POI, but you can still see the idea of what's happening here, right? It swept that low, demand came into the market and we've come off it, okay? Let's kind of move along a little bit. So, we just keep getting those larger breaks of structure, just following that bullish order flow. Okay, this time we come into, I think this is a flip. So we have this level of demand here. Okay, didn't sweep any liquidity. So this is not what I would call a sweep POI because, let's have a look at it. All right, if you look at the fractal structure, we come up, we pull back, and then all of those candles break the previous candle's high, then we pull back, and then we go. Okay, so if you look at that, it's just an up movement, down movement, up movement, down movement, up movement. So we don't sweep any actual low. Like for there to be a sweep zone, it would have had to sweep that low there, right? It would have had to come down, grab that low and go. So it would have had to sweep this. If that had done that and gone like that, then I would call it a sweep zone. Because for me, or at least at the time of recording, I want to see like an actual, a minimum of like a fractal low that needs to be taken. Now, some people, they will look at like the wicks of the candles and they will say, price came down, grab the liquidity below that low there. And that's for them. Now on a lower time frame, that's probably what would happen, because on a lower time frame, how would that look? It would look like a down movement, an up movement, right? And then price is taking the low. On a lower time frame, you go down to maybe the 15-minute. But on this time frame, think about it the way that we look at fractal structure. What happened? All of those candles broke the previous candle's high, then we pull back, and then we went. So for me, there's no sweep on this time frame. But some people, when they're defining sweep zones, especially with flips as well, they will see that as a valid sweep, okay? So I'm not saying one is invalid or valid. I'm just saying the way I would recommend you guys do it when you're starting out is the way I'm saying now is you want to see it to be an actual low on this time frame, okay? So that would be the low that would have to get swept, because in theory that should be more significant, right? Because it's an actual structural low on this time frame. Okay, so I would start with that as your starting point, and as you get more experienced or you collect more data, but you're then happy to see a sweep zone like that, where you can see that on a lower time frame that would be a sweep, you may want to include that, okay? Because some people do that with their trading. But hopefully I made it clear. I would recommend you start with the more conservative approach, which is wait for an actual low on this time frame to be swept. That would be sort of my recommendation. Let's speed this up a little bit, because I don't think this needs to be a super long video. But yeah, we'll just do a few more sort of obvious examples, right? Again, we pull back. What do? We mitigate that flip, right? So this is where we had that initial interaction from here. Okay, it's a little bit messy, but there we go. You can see where demand took control from supply, led to the break of structure, and we pull back. What do? We build some nice equal lows, okay? And then you see that's that aggressive nature that I was talking about. You kind of get that corrective, and then boom, big money is potentially using the sell side liquidity to enter their long positions to then generate the next move to the upside. And that's what I was saying at the start, right? You kind of get these move up, you get this sort of low resistance, right? All of that liquidity building up behind those highs because none of it's been really swept. I mean, there was a bit of a sweep in here, okay? So that would be, and you can see, right, that POI gets respected because we come down, have a bit of a fractal pullback, grab the liquidity behind that high. So that would have been a potentially good, nice counter trend area to look to get involved on lower time frames, right? Price comes into that 4-hour POI, that swept liquidity, and then we can look for a quick counter trend play down into demand, okay? But you see behind that, now you've got all of that available liquidity that's been untapped, and that's the liquidity to target, okay? So typically, like I was trying to say there, is what you get is price will break structure, okay? Like that, and then you get kind of usually these corrective moves, which we can trade to the downside, but it leaves that liquidity for us to target, and then price will generally come in, either form equal lows like this, sweep into the previous protected low, and then we get the movement, or like similar thing, corrective move down, and then we'll get like a low that breaks a high. That's the low that then gets swept, and then we go. That's very, very typically what will happen, and then that becomes a much more sort of protected low. Why? Because it signals that big money was involved in there, so they potentially have the intention to try and protect price trading below that low now. Again, what do we have? Price comes in, comes up, grabs liquidity below that low, and then we go. But eventually, we end up sweeping that low, right? More equals, and then we go again. And then we get another break of structure. And then obviously at some point, right, you could be using multi-time frame analysis. We've probably come up into a big daily level, up and towards or sweeping these highs. There's probably like a daily POI up here, right? And we start to shift a bit of structure to the downside, okay? So not getting too much, like I said, into trade ideas. It's more just kind of generally spotting how these sweep zone forms and how those protected swing ranges form right below, as I've kind of gone over. And yeah, we end up actually, you can see, on a bigger scale, we come into this low down here. We build some nice equals, enticing more traders into the market to generate more sell side liquidity below those lows. There we go, trying to draw the poorly drawn dollar sign, sweep that liquidity, and then we go, right, even on scale there. So you've got a nice POI, sweep POI, strong movement there to the upside as all of that sell side liquidity is used, and then almost bring us to where we are. What do we have? See how it just keeps happening now. We come in, we come up, grab the liquidity below that low, then we get a break of structure here, and then this one happens quite quickly. It's probably news or something, but you can see as we break this high here, right, it happens almost in the next, basically straight away in the next candle, but you would have had, right, this breaks the high, so there would be decent liquidity below that low, and price literally comes down, grabs it, not by much, but you literally grabs the liquidity behind that high, and then fuels the next movement to the upside, right? So that was a super quick sweep of that low. After that low had already been swept there. And then we get another mini one here. So price comes down, pulls up, comes down, sweeps the liquidity below that low, another break of structure to the upside. That then becomes your next sweep POI. Now with those sweep POIs, for like the ones where you get, so price comes in and then you get like a break of a high there, and then you sweep what we call like the strong low, right? That I love POIs that do that. They don't have to. Remember I said with sweep zones, it can just sweep weak structure. So you can also have the example where, let me zoom out a little bit. Okay, let me just go back here. It's easier to show. Here, right? So that's a sweep of a weak low. That's a sweep of a strong low, right? Actually broke structure. So both of those are valid. I just prefer one that sweeps strong structure because arguably more sell side or more liquidity, right, has built below that low to break that high. So in theory, that should be a better zone. So for that low to kind of what I would deem to be somewhat strong, like this low here, right? So we pull in, we come down, we come up, and that just breaks the high. So are we saying this is a strong low that then gets swept? I would prefer it to be one that actually does cause a body closure, okay? But wick break will take it. It's better than not having it. So we get a sweep at that level, come back into the sweep POI, and that would be a level there. And then that pretty much brings us to where we are. I don't know if there's any sort of more clean, obvious examples. But yeah, so hopefully you can kind of get the idea of just what we're looking for. I don't think it's anything too complicated. It's just what we usually do is we just look for those zones as we have been before that lead to a break of structure. You draw it on, you draw the analysis where market structure is it well priced? And then if you just want to ask yourself, is it a sweep zone? Just look left, and did it sweep any available nearby liquidity in the formation of that zone? And it can be another tick in the box as to why this should be an institutional zone and likely will be a protected low. Before we move on, I kind of just want to touch a little bit again, very briefly, on that idea of, how those, protected ranges, those swing ranges are formed with those sweeps of liquidity, and kind of how that, the difference between high resistance and low resistance liquidity. So, just like we're doing on GU and the 4H, but here we're just on the daily on euro dollar, like very often when you get that strong protected low, what does it do? It grabs the liquidity below that low. Just kind of loosely go through this bit. Right, we come here, we kind of form those obvious equals, and then we big grab liquidity, and then we get that strong movement away, okay? I mean, not everything's obviously going to eventually hold, depending on multi-time frame analysis and everything that's going on, but very often you'll see before that next strong sort of move can go, what does it do? It grabs the liquidity below that low. Again, quickly going through some examples here. We get kind of the overall push down, but it grabs liquidity within that leg to then fuel that next movement to the downside. Then we come to the upside, it just sweeps liquidity behind that high by a pip or two. That's one's really, really subtle to see, but I promise you it did just sweep the high there. And then we get the movement to the downside. Again, right, we get the pull back up. Like very often, you're not just going to get like price break a swing low, it comes back up. It's not just generally going to come up with one move and then just come down with one move. Like usually that first pullback up into here, it entices those early sellers into the market, then it grabs liquidity, and then that's usually when you get the movement. And it will usually, just have what we call like low resistance liquidity at the low to target, and then it leaves high resistance, or that high resistance liquidity is taken. So essentially what that means is you've got just all of that liquidity there sat below those lows. That would be a low resistance low. A high resistance low would be like if the low formed where you got something like this, right, and then it grabbed the liquidity like that. So now if we were pro trend and we're targeting that low, this one's probably going to be a bit more sticky because there was obviously a bit more liquidity grabbed in this move, so potentially there was institutional involvement in generating that low. Sometimes when that happens and you get something like that, you can get price come in and it has like a much deeper pullback before we get the real movement. So kind of show you examples like like here we get the movement down and then come up, we build all of this liquidity for November and December, grab all of that liquidity, and then we just have all of this low resistance liquidity like this, right? Like trend line liquidity to target. And that's usually why you see that impulsive movement. All of the demand in here is all being absorbed, right? All of these mitigations. Like, so when price comes down, there's just a vacuum in price almost. There's no real demand to absorb price. And then you get that sharp movement to the downside. More examples here. Like I said, right, price doesn't just come back up and just go. Usually you get another movement like that, then it sweeps liquidity, then we come down, pull back into the sweep POI, right, and then we get the impulsive movement there to the downside. Another example here, right, sharp movement down, there's no sweep liquidity down here, we just get that pullback, and then we build some more liquidity, grab the liquidity behind those highs, right, mitigate the decisional flip zone there, right, that flips the demand here, pull back into there, and then we go. Again, get a break, but we don't just like go down, we come up, come down, grab the liquidity behind the high, fuels the next movement to the downside, right? Let's see what else. Like even back here, okay, this one's a bit more because we do have a bit more of a significant pullback there. So potentially, there's somewhat of liquidity used, a bit more of a protected low came in, and this is where it was tricky because, market's not always going to be super easy to read. Like I remember when back here, I wasn't sure, is that going to be like the true daily break of structure? Are we now shifting bullish and are we going to see this movement? Or, is that just an internal break and this is a larger movement? And that's where you can kind of play both sides of the market, right? Look for the shorts when we come into here, we get the pullback, sweep the liquidity, break of that low. Now you've got to sweep POI to get short. And potentially we can target this low, but then we've also got this potential low here. This is where you can trade both sides of the market. But as we can see, right, we have that impulsive movement down, and then this just doesn't really go anywhere. It's just corrective, building more liquidity, sweep of the high, fails to move, get another sweep of the high, and then that's enough to fuel that movement there to the downside. And then, another example of low, like it just leaving a low resistance low, right? There's no real sweep of liquidity, right? We don't come down, do this, like get a strong sweep and then start pulling back. It's just we come in and then we just come back, right? Build that liquidity, grabs the liquidity, mitigates the previous decisional flip there, and then we get the movement in, right? Corrective movement. So this is a bit more, again, where we could, okay, potentially maybe we're going to get a sweep and go higher. Ends up not being the case. This is a bit more tricky to read. And then we end up shooting to the downside again. And then obviously eventually then we start to shift bullish as the trend comes to its eventual end. These sweeps are a bit more clear on the lower time frame on the 4-hour chart. I'm not going to dive into all of that now. And then we eventually move to the upside. And like I was saying on GU, right, what do we get? We get a movement in, grabs the liquidity below that low, fuels the next movement there to the upside. Same thing, right? We pull back here, grabs liquidity below that low, fuels the next movement to the upside, okay? So you can start to, see how that forms, and it can just sort of help you to understand the flow of the market. Alrighty, so now we are simply going to look at flip zones that also sweep liquidity. So it's the exact same concept, exact same theory of what we look for with the structure zones that sweep liquidity. We're simply looking for, did the flip sweep liquidity in the creation of the zone, okay? Did it grab some liquidity as it was being formed? That's it. Because remember, what's the reasoning we're doing behind that? We are looking for where potentially institutions used available liquidity, so I'll get into this in a minute, but behind a high to enter the market. It's like another filter that perhaps means institutions were involved in the creation of that, okay? So not only did it break structure, not only did it take out another zone, but it also used liquidity as it was formed. Okay, it's another little filter that we add on top. All right. So before we kind of dive into all of this, you've probably seen all of these variations and all of these ridiculous names, and you don't need to memorize any of this. The names don't really mean anything, as in, this is just some rubbish I came up with to try and separate them. But essentially, I view all of this as the same. Okay, and you don't need to picture it. I'll make it hopefully reasonably simple for you as we get into it. Okay, so let's start here with the left-hand side, which is what we've been looking at before we got to the liquidity module, right? Which is simply just a standard flip zone. Okay, so we'll start with demand. So price is moving to the upside. Okay, this low breaks this high. So what does that create? It creates a demand zone, right? That led to the break of that structure. So then if demand, let's get my paintbrush, if demand is going to be able to do its job, right, what should happen? Price should come into the demand zone. It should react. The reaction is key. Obviously, price reacts in this instance. And if demand is going to do its job, it should move price to make a higher high, right? It should break structure. But as we can see, it doesn't break the high. It doesn't form a higher high. And then price moves to the downside. So what that means now is supply has stepped in and it's overpowered demand. Okay, so we've had a reaction from demand. That reaction has failed to do its job. And then price is broken and closed below the reaction. Okay, so when we get a break below there, that's when the reaction has failed, but we only get true confirmation that the zone has completely failed when price actually trades through it. Okay, so we get a failed reaction there when price moves below the reaction, but we wait for the actual whole zone to fail, right? And then that's when we get in this case, the shift in structure as well. Okay, so I'll go over it. We get the reaction to demand, the reaction fails to do its job, price has a failed reaction, then the zone fails and structure fails at the same time. Okay, so now you have a demand to supply flip. Okay, so anywhere from the low of the reaction, okay, to the top of the reaction, that's where we can draw on our demand to supply flip range, right? Anywhere within that range. And then like I've done here, we can obviously refine it to the pivot zone within that, right? 1 or 2 candles or whatever. Okay, so that's the standard flip zone. And then obviously the same for supply to demand, where price comes into supply, it fails to do its job, it fails to make a lower low, and then we get the failed reaction, the failed zone, and the structure shift in this case, right? And then we look to enter on the supply that caused that to happen, okay? Now, in this instance, what do I call it? A no sweep flip, because it doesn't sweep any liquidity in the creation of the zone, right? The flip doesn't sweep any highs. If you look at where all the highs are, right, in here, at no point or within the flip does that get swept, right? So when price comes down here, and you're looking for, this is the flip, did it sweep any high? Well, it didn't sweep that high, and there's nothing here, and there's no highs here. It's just a straight movement up and down, right? So just price comes in, price comes up, there's no highs that it breaks, and then price comes down. So when you're looking down here, and you look up at this flip, did it sweep any liquidity? No. Whereas now when we look at the flip zones, or the sweep flips, they all did, right? It's the same thing. We have demand, price comes into demand, the reaction is key, but in that pullback, right, in the reaction, what does it have? It forms, I guess you could call it like an internal high within there, right? So price moves down and then price sweeps the liquidity that would have built behind that high, right? And then we get the movement to the downside, okay? So then when you're looking at this flip here, whether you take the whole range or you just refine it to the pivot like I have here, and you're looking left, what has it done? It's swept the liquidity behind that high, okay? And these are all just variations of that. So this one, basically the same thing. We come into demand, we react, but rather than just one little high, we get some equal highs, right, that build up. So we know there'll be some, double tops, lower time frame traders, whatever, trading that range. Liquidity gets swept, and then boom, we get the demand to supply flip. Likewise here, this one we get an initial reaction from demand, okay, fails to put in a higher high. Price moves down, but we haven't quite failed the zone yet or broken structure, and then price moves up again. And what does it do? It grabs the liquidity behind the high from the initial reaction, and then we get the movement, okay? So we assume that an institution probably stepped in here to overpower demand, and it used the liquidity behind that high from the initial reaction, right? And then last one here, so again, very, very similar. It doesn't really make a difference. It's just a high was swept in the creation of the zone, right? We come in before we react to that demand or the pivot demand, we have a little bit of a pullback. Then we get the reaction from the demand zone we're looking at, and that reaction fails to put in a higher high, right? It fails to do its job, but it sweeps the liquidity behind that little high there, right? Institution steps in, use the liquidity behind that high to overpower demand and break structure, and that's it. And now we have another sort of variation of And there's probably other variations, right? These are just kind of the few obvious ones. But all that matters is when you're at this point here, okay, and you're looking at a flip, what you're doing, you're just looking at, okay, there's your supply zone, it flipped demand and broke structure, so I'm going to get short. You're going to be doing it at the exact same point here. The only difference is you're just asking yourself is, when that flip formed there, did it sweep any liquidity to the left? Yeah, it grabbed the liquidity there. When you're here, okay, it's a flip. Did it sweep any liquidity? Yeah, it swept those equal highs. You're looking down here and just asking yourself, okay, there's a flip, I can identify it. Did it sweep some liquidity when it was formed? Yeah, right? Down here again, you're just looking, okay, yeah, it swept some liquidity there. That's it. So I personally view all of these as the same. It's just a flip that swept liquidity, right? I don't necessarily view any on their own as any higher probability than the other. Now, some of you might want to be very strict with all of these different ones and you might want to collect stats on them. But for me personally, I view them all as the same, okay? And then likewise, we'll quickly just go over the opposite. You essentially have price come into supply, it reacts, it fails to put in a lower low, but in the pullback of that reaction, what does it do? There's some liquidity here. Now, one question some of you may have is, how strong is this low, right? This low didn't break any structure at all. So how much liquidity is behind that? Yeah, maybe not a lot, but for me, that is enough for it to be classified as a flip that sweeps liquidity, okay? So for some of you, you may view like a flip like this as higher probability because technically this low did break at least some structure, right? It broke that high there. So arguably there's more liquidity behind that low than there is behind this little weak internal low there, right? In theory, right? That makes sense. But I personally haven't necessarily viewed this as any more higher probability than this. Like I said, right? I just keep my trading somewhat simple. I know some people are probably thinking it's not simple at all. That's a totally fair assumption, right? But I view all of these as a flip that sweeps liquidity, okay? So like I said, I don't want you to feel overwhelmed by this. It looks like a lot of variations and probably a bit weird to get your head around, but you are literally just looking for a flip like we have done before. But in this bit here, you're just looking at, where the zone is, did it grab any liquidity to the left, in a formation of it? And that's it. And then we simply just say, rather than just a flip, we call it a sweep flip, okay? Maybe you've got a better name than me, but that just makes it easy enough, okay? So hopefully that makes sense. We're simply just looking for, remember, the philosophy of what we always bring it back to is we're looking at a zone. We can ask ourselves questions of what are the odds that an institution was involved in the creation of it? Did it break structure? Yes. Did it overpower another zone? Yes. And was liquidity swept within it? Okay. So looking for sweep zones, it's just another filter to increase the probability of the zone. It's not a necessary requirement, okay? Necessarily, it may depend on what your plan is, but for me, it just needs to have at least broken structure, okay? Cool, let's go look at some real examples. Okay, so with flips in general, and also, sweep flips, ones that sweep liquidity, when you're first kind of trying to get used to this idea, and especially when spotting them on the charts, understandably, it can be sometimes a little bit confusing to spot because they come in all different shapes and sizes. They're always going to follow the same framework. They're going to have the same, things that identify whether they are a sweep flip or not, but they're always going to look, like I said, unique, right? So whenever you kind of keep it simple, right? If you see a pivot point in price, right, we know that's likely where an injection of supply came into the market. So we look ideally for the buy candle that then gets the sell candle that closes below it, right? And then we can draw on our supply level, but what's the first filter that we use to justify that it's what we call, a strong zone, an institutional zone? We want to see, did it break at least some form of structure? So at a minimum, it must break a fractal high or low, right, at a minimum. So in this case, we go, right, okay, we have a pivot point in price that led to some form of a break of structure. Okay, happy days, that's a structure zone. Let me just redraw something. So let's say we have something like this, right? Okay, so first step, you go, right, price is here, I want to see, potentially we can look for a supply zone. Is there a pivot point in price? Yes, we can see there was an injection of supply there. Did it break some structure? Yes, it broke that low. And you would draw on your supply zone, okay? So now now the next step, you would go, okay, I have a structure zone. Is it a flip zone? So what's the first thing you would look to try and see if it's a flip zone? Is look, where did the reaction start for the pullback of the flip? Sorry, the buy to sell, right? So you've got a zone, that pivot point in price that led to a break of structure. If you want to know if it's a flip, just look where that pullback started from, that reaction, and then look left. And that's how you'll find out if this buy to sell is flipping another zone, if it's reacting from another zone, right? And as you would see in this case, you would look left and go, oh yeah, there was an unmitigated demand zone here, right? It's a valid zone that led to a break of structure. So now you see how you start putting the pieces of the puzzle together. You're looking for a pivot point in price that's relevant. Did it break structure? Yes. Right. Can I draw it on where you have a buy candle where the next candle then closes below it? Right. And then you go, okay, I have a structure zone. Is it a flip zone? Well, where did the reaction start from for this pullback? Look left. Oh yeah, there was an unmitigated valid zone over here. So now I can see that I had a demand zone that broke structure. Price came into that demand zone. It failed to do its job. It failed to make a higher high, and price has then overpowered that demand, right? Supply has taken control. So the next step then would be, if you want to know if it's a sweep, a flip that swept liquidity, when you're at this point and you're looking at your zone, you just simply go in the creation of that zone, in this movement here, was any structure swept? Was there a high taken? Well, in this drawing there wasn't, right, which is this example here, but then you get all of these other examples where you're at this point and you're looking at your zone, you've seen that it broke structure, you've seen that it flipped another level. All you're asking is this bit here where the actual flip occurred, was there a high taken, whether it was within the pullback like with the first two examples, or like the initial reaction gets swept and then we go, or there's something in the previous leg, and that's it. That's all you need to look for. Now, like I said, I personally view, or at least at the time of recording, I view all of those sweep flips basically as one and the same. But for some of you stat junkies out there, you may want to record these as different, different flips within your journal and things like that. And when you're backtesting, and see if you can find different stats on those. But for now, I've kept it pretty simple and I view them all the same. So let's take a look at these on the charts. So Euro-dollar here, 15-minute chart, but really doesn't matter. You can look at any time frame you want, the 7-minute, the 8-minute, the 3-hour chart, the 27-hour chart. Markets are fractal, right? It's all the same thing. Candlesticks are just making sense, of that price data. So let's kind of just dive into some price action and let's see what we can see. Now, what I'll say again is at this point, I'm literally just going with you and practicing identifying whether something is a flip that swept liquidity, whether it is a sweep flip. At this point, we are not thinking about whether we should trade from it, what kind of trade idea, how we're going to trade it, none of that, no market structure. We're literally just identifying where is a sweep flip, and that is it, okay? In the further lessons, that's when we'll start to put it all together and start to formulate trade ideas, right? So straight away, if you want to kind of train yourself again, just keep it simple, right? Pivot in price, okay? So we know that demand with that sell to buy came into the market, right, to push price to the upside. So at a bare minimum, did it break any structure? Yes, okay, we can say, that it broke that fractal high, right? So first step is you have a demand zone, right? And we can obviously take the whole range or we can refine it to that nice sell before the buy, right? Nice clear zone, okay? Cool, happy days. So that's obviously a demand zone. Now, what do we do to see if it's a flip zone? Well, we look left from where the reaction started, right? This is where the pullback of the zone started. And we look left. And is there any unmitigated zone that it's reacting from? And as we can see, right, we have this level here. And you can take it from like the low to the high, right? So you get to the buy to sell pivot. Or you can obviously refine it a little bit more to that like that. And as we can see, price traded into it. Now, it must stay within the zone. If it trades any higher, like even if it just spikes it, then that means this zone's invalidated. Like even if sometimes I'll do that and draw it to the whole range. If this move had to come in and just spike that by micro pip and then pull back, that for me would not be valid, right? Because this supply needs to contain price. The reaction must stay within. If price did this and then pull back, like if it went just above and pull back, not valid, right? That would not be it reacting from supply because supply has failed. Obviously in this instance it has, supply contained price and it reacted. So if this supply here, right, is to do its job, what should happen? It should cause price to at least break that low, right? Break some structure and form a lower low. It's failed to do that, right? So the reactions come in, demand stepped in, and then we've broken and closed above the reaction. So now we have a flip. Okay, so we found a demand zone that broke structure, it's flipped another level, so now we have a valid flip. So now the simple question is, did it sweep any liquidity in the formation of its zone? So the only area we're looking at to justify that is in the actual reaction in the pullback itself. Was there any low in here that was swept? Okay, this one's a little bit more subtle, but it's valid, okay? So the reaction starts here, and if you look at the lows, right, price came down, and then the next candle fails to break that previous candle's low, right? Which means we've then pulled up, right? And then we've come down, and then we've gone. So if I just drag that over here, well, I drew it in two pieces, but essentially that's what it looks like, okay? So that's where you have a low that formed in the market, price went up, came down, and used the liquidity below that low, okay? So the liquidity will build below that low, and the theory is that sell side liquidity is where institutions are going to use that sell side liquidity to buy into the market, okay? They're using that liquidity to enter their long positions with minimal slippage, right? That's the general theory behind why we see it as another filter that can potentially signal there was BFI involvement in the creation of this flip. So demand was strong enough to break structure, it was strong enough to flip another zone, and it used liquidity, it swept liquidity in the formation of the zone, okay? So that is a flip that swept liquidity. And that's the process you want to go through the whole time. So keep it very simple when you're looking for supply and demand zones. Just look, where are those pivots in price? Did it break structure? Yes, okay, so that would also be a valid zone, right? You obviously got the whole demand range, which we can see price tapped into to continue. You have the refined pivot zone within that. Okay, and if you wanted to know if that's a flip zone, well, that's the start of the pullback, right? Look left, did it react from anything? And yes, we know there'll be some supply in here, but on this time frame, that's not really a valid supply zone, right? It's just bearish candles all trading lower, so not really something I'd be interested in. Now, if this was, imagine this was a nice like pivot in price, and we did have a supply zone, then yes, then that would be a reaction that sweeps liquidity, right, below multiple lows here. Really nice flip zone that would have been, that then moved higher. But in this instance, because it didn't actually react from a valid supply zone on this time frame here, it's not a valid flip, not a valid M15 flip, okay? And that would be the difference. But this is a structure zone that did sweep liquidity, right? You can see all of the trend line liquidity there, swept the liquidity and moved to the upside. It's just not technically a flip, okay? Cool. Let's see if we can kind of see anything else. Obviously a little bit messy price actions. Again, not talking through trade ideas, just purely looking for a zone, okay? So we can see here, another pivot in price, right? Broke structure. So first step, draw on the low, that got broken, okay? And we can look for the supply that caused that move, okay? So bit of a messy one. Obviously the most ideal way to draw it would be like this on a single candle pivot, or you can take that sort of buy to sell range, or you may even want to include the whole high there, right? But let's just take this. Now, let's see within here. So yes, this would be a flip, but it doesn't sweep liquidity, okay? So remember, what do we look for if it's a flip? We look for where did the reaction start for the pullback? Look left, what do we have? Do we have an unmitigated demand zone? Yes, we do. It's a valid zone, right? That broke structure to the upside. So when price comes back into this zone, it reacts. The reaction is key, but what should the reaction do? It should make a higher high. If it fails to do so, supply comes into the market. So from the low of the reaction to the top of the reaction, just like we've drawn here on the blue box, that is your demand to supply flip zone. The difference here is that this zone did not sweep liquidity. How do we judge that? Well, we judge this pullback here from the low of the reaction to the top of the reaction. In that pullback there, were there any highs that were swept? Were there any structural highs? Well, no, because price just comes down. All of those candles break the previous candle's low. All of these candles then break the previous candle's high, and then it comes down. Okay, so if we look at that, what is it? It's just a low, a high, and a low. There's no high swept, right? For there to be a sweep, you would need to see something like this, right? A high that gets taken. Nothing gets taken in here, right? So that's why it's just a flip that didn't sweep liquidity, okay? So that's not one that we would count as a valid sweep zone. Let me just draw on the liquidity there to show you how that was a sweep, okay? Cool, let's see if there's anything else. Gets a little bit messy and tight within here. So let's see. So yeah, so pivot in price to the upside, okay? So we obviously know some demand has broken some structure from within here. So let's just draw on that zone as a starting point. Okay, we can see that we have a zone that broke structure here. Now, if we want to know if it's a flip zone, what do? We look from the start of that pivot in price, right? The start of the reaction, look left. Do we have an unmitigated zone? So this one's a bit of an interesting one, right? Because you've basically got it like that, just clean it up a little bit there, take the whole level. And what you have in this instance is you have the initial reaction from that supply, right? It reacts, fails to put in a lower low, and then price moves up. Now, in this instance, remember, for me, I need to see a candle closure above where that reaction starts for there to be a confirmed failed reaction. Okay, so we react and we move up, but on this time frame, we never close above the reaction. So that's why, for me, I prefer to wait for the candle closure, which we don't get to here. So once we get that, then yes, then we have the flip, okay? So when we're up here, and if you were interested in this flip, that's when I would be looking to get involved, okay? But if you're looking to see if it's swept liquidity, obviously this is a bit of a messy one in that whole reaction, but can you see that a low was formed that then got swept by the time then the flip was completed, right? You can see price came down, next candle fails to break the previous candle's low, right? So that means that price moved up. So now you have a low, price has come down and it's swept that low and then moved to the upside. And then you get the flip, right? So that is another flip. That's swept liquidity. What's also nice is it also mitigated the extreme. Okay, so then if you're looking at this as a trade idea, you've only got one zone you can trade from, right? You're following the mitigations, that's done, so now you've got a nice easy zone to pick from. Okay, so this type of, let me just draw on the thing, the sweep. This would be when like the initial reaction gets swept. Okay, so if we look back at the examples here, it would be this one. Okay, so price comes into supply, initial reaction, it moves up. We don't break structure or get the failed reaction just yet. We sweep it and then we go. That's what we're looking at here. All right, price comes in, whoops. Price comes in, it reacts, it pushes up, it forms a low. We don't get the fail reaction out of the breaker structure, so we're just chilling. Then we get the fail reaction, supply fails, structure shifts, and now you have your supply to demand flip, that's swept liquidity, right? And then again, got another one straight away, okay? So we obviously have another zone that broke structure here. Okay, so we know we have valid demand. Now where you would draw your demand zone is a little bit messy in this one, right? Price action is not always super clean because obviously if it's super messy like this, I'll just draw it on the big candle at the bottom, like getting that pivot price and the reason why I say it's messy is you see how the next candle fails to close above it. So then you could refine it to here, but then like the next candle fails to close above it, then you can refine it to here, right? So maybe you want to take that sell to buy range. Or maybe if you want to keep moving it along and be super mechanical, then you can move it to the first candle where the next candle closes above it. But you can see price ends up breaking it. So when you kind of get messy price action like that, it's a little bit tricky to know exactly where you want to have your refined zone. And if in doubt, just take the low because at least you know that's the more structural point, right, that broke the high. But in terms of this level, right, what did it do? It broke structure. So what do we do if we want to know if it's a flip? Look where the pullback started. Look left. Did we react from any supply? Not the best, but we do have an unmitigated wick there, right? So we can say that we flipped the supply that was left within that wick. Did it sweep liquidity? Well, where do you look? You look within the reaction leg. What do? We came down, we came up, we formed a low, we swept that low, and then we got the break, okay? So we have another flip that swept liquidity there, right? So you see how they all come in different shapes and sizes, but it follows the same framework, the same, things that you identify with it, same criteria is what I was looking for there. To say whether or not it's a flip. I'm just going to look at a few more examples before we move on. So again, another pivot point in price, right? You can see some demand must have come in somewhere in the market to break structure. Where was the structure break? It was up here. Just keep it nice and clean. And there's multiple levels, right? We've got kind of, is there demand here? Is there demand here? Is there demand here? Well, let's kind of paint the story a little bit. We've got the extreme, but we've already had a mitigation. Okay, so wouldn't really be that interested in that anymore. So you can move it along. Right, you basically have this whole range and you've got another potential zone here that you could potentially look at as well. There's a little bit of a mitigation here, but I wouldn't be too concerned with that. But yeah, if you're being super strict, then obviously you can, follow it along and build a bit of a demand chain from within here. But it's this whole general area, right? Is that demand that led to the breaker structure, okay? So if we are looking at whether it's a demand zone, this whole area, yes, it broke structure. Okay, did it flip anything? Well, where did the pullback start from? It started up here. Do we look left? Are there any supply that makes sense? Yes, we have this supply zone up here that broke structure, okay? Kind of looks like it, yeah, it did mitigate it. So this one here is another nice one, very similar to one we just looked at before, where you have the initial reaction into supply, right? It pulls back, price moves up, it creates a low. We then sweep that low, we mitigate the extreme, and then we go, right? So that is another one where the initial reaction from supply gets swept. And that is your flip there. Now where you would refine, because basically the flip, right, is from the high of the reaction to the top of the reaction, okay? So this is where you can be a bit unrefined, or you can try and find the pivot within that. So it was a little bit tricky in this case, but that's why I was saying, if you're ever in doubt when you want to refine a larger supply and demand range to a pivot, and you're not quite sure, just take the extreme of that, that pullback, the sell to buy, because that's essentially, right, your strong piece of structure. And typically that's what price will end up a lot of times rejecting, okay? But you can see what we're more focusing on is the idea that the reaction got swept and then we flipped the supply, okay? Have we got any more? Kind of another similar one up here, right? Another pivot point in price led to a break of structure. So let's say we broke this high all the way up here. So, you've got your nice extreme there. So what do we do? Again, broke structure, demand. Did this react from anything? Look left. Yes, we got this level of supply here. Oops. God, my monitor's making creaks. Hopefully that's not been too annoying in the microphone. I only just noticed. But yeah, so we've come into supply here, right? We've reacted, clearly not broken any structure. Clearly supply has not done its job. And then as soon as we close above the reaction point, at this point, you now have a confirmed supply to demand flip, right? The reaction has failed. Once price closes above the start of the reaction, that is your range. But obviously, you know, in terms of trade ideas, you still kind of want to see the actual supply zone itself truly fail. The reaction fails, remember, at this point, but you don't just get in straight away. You want to see like supply actually get cleared out, structure shift, and then that's typically when we're much more interested in the zone. So you've either got the whole range, or what we can do is refine it to the pivot within it, right? The extreme of the reaction leg if you want to be a bit more refined. Okay, excuse me, and what do you want to know if it swept liquidity? Anything in the reaction leg, was there any lows in there that got swept? Yes, we came down, we came up, we came down, right? So we swept the liquidity below that low there. Cool. I'll go through a few more examples, but I'll go through a bit more quickly because I think you guys kind of get the idea, but I just want to show you some slightly different variations. So this one's a little bit, yeah, I think this is valid. So another pivot point in price, right? So let me see. Yeah, so we have demand here, right? It's kind of a messy demand range, but you've generally got this whole range along here. Okay, we actually pushed through. So technically that's not valid. So I'll talk through it anyway. Imagine, just if you can for me, imagine that price came in and it never breached the zone so that this demand was respected. Just imagine that, right? Let's just pretend just so we can see this example. So if this demand is going to do its job, when price comes in, what should happen? It should go on to make a higher high. All right, price fails to do that, and then we break and close below the reaction, okay? So again, imagine that we did hold it, or we obviously didn't, but anywhere from the low of the reaction to the top of the reaction would be your demand to supply flip. That's obviously quite a big zone, so you know you can refine it to the extreme or maybe that inside bar. But the reason why I wanted to talk about this example is because in that reaction, what did it do? It swept the liquidity behind a structural high in the previous leg, okay? So this is an example to show you of this one here, where it sweeps, right? We react from demand, we come up and sweep a high in the previous leg, right? We never actually put in the true high, and then we come down, okay? So that would be that example where flip sweeps the prior leg, all right, here, and we come up and do that. So that was a nice example of that. All right, let's just look at one or two more examples, and then we'll start to wrap it up. Here looks kind of interesting. Okay, we'll look around here, and then we'll call it a day on this one. But yeah, so, right, pivot point in price, clearly break structure, where we take this low down here, okay? So we obviously have supply. Well, let's draw on the demand first, right? We've got demand here. That's a valid demand zone, right? It broke structure. So when price comes in, what should happen? It should make a higher high. Price reacts, fails to put in a higher high, and breaks and close. So once we get a closure below the start of the reaction, that is your demand to supply flip. But ideally, we want to wait for demand to actually get cleared out and structure shift, which is what we get down here. So if you're looking at supply, you can take it from the low of the reaction to the top of the reaction, or obviously you can refine it to the unmitigated pivot within that, which should be here. You might want to keep that wick anyway, just in case. All right. Now that's a flip. Did it sweep liquidity? Nice clear one here, right? Got a high in here, swept liquidity there. So that's a nice flip that swept. And again, remember, not saying we want to trade all of these. Just because you see one doesn't mean you should be trading it. This is just purely identifying it. It's nice to add a previous mitigation there as well. But yeah, that then obviously gets flipped. So this is what I mean. This can happen a lot. You can see who is taking control and where. This interaction between supply and demand. That's what I think is so cool about supply and demand, right? You can see just how the money exchanges hands, right? Price comes into supply, reacts, fails to put in a lower low. That reaction also mitigates this extreme here, right? And then we push up. But that's a valid flip. Is there a sweep of liquidity from top of the reaction to the lower of the reaction? Obviously, you can refine it to inside bar. For me, no. There is no, this doesn't sweep because we just come up, we just come down, we come up, we come down, and we go up, okay? So there's no low taken, right? There's nothing, there's no structure swept there. Now, some people will say that that is a flip that swept because it swept that there, okay? For me, it's not valid. At least the time recording, I don't see that as a low on this time frame. That is a low on a lower time frame, right? If we were to go down to, say, the 5 minute, what would you see there? You see an up movement, a down movement, and an up movement, and then price will come down and sweep that and then go up. So yeah, on the 5 minute, that would be a flip that swept liquidity, but on this time frame, it isn't. Now, some people will use that in your trading. Maybe that's something you want to use in the future, but I would recommend when you're starting out to ignore those for now and just focus on structure in this time frame. Like here, what do we have? We have an up movement, a down movement, an up movement, then price comes down and it sweeps that low on this time frame. So for me, that is a sweep zone, okay? So I'll quickly just draw that on and then I think that will do. But yeah, that's a good example kind of what I classify as valid for a sweep zone, right? That then broke that high. So we have a valid demand sweep zone. Did it, is it a flip zone? Well, where did the reaction start? It started here, look left. Oh yeah, look, there's some valid unmitigated supply. So we actually swept, we flipped this level, I should say, this supply level here, right? We came into that supply, reacted, swept liquidity in the previous leg, and then moved to the upside. So now you have a flip that sweeps, right? So on and so forth. Another one here, sweeps the low, continues to the upside. Did it flip anything to the left? Nah, that one's a bit, this is where you can get a bit loose with flips, right? Because technically what this has reacted from, there is going to be supply there, right? But it's big, it's massive, it's more of like a big pivot and a range. And that's why I'd say for the most part, when you're looking at flips, just try and focus on the ones that kind of react to an actual pivot rather than a big level like that. Now, if you get like, a bit of a small range, like, like this one where it's quite tight, then yeah, it makes a bit more of it. So you can say that we're flipping this range, right? And it's nice. But when you get something big, you don't want to say like instantly just go, well, we've flipped this range, right? Because then you could get another flip that forms here. And like, that's the actual one you want to focus on because it's flipped on a more refined level, okay? Otherwise you'll just start drawing massive flips everywhere. But hopefully that's a bit more, or helped you to kind of, make it clearer in your mind, what these flips looks like in reality, but they all follow that same process. And hopefully you can kind of see that systematic framework that you follow. Look for a pivot in price. Did it break structure? Yes. Is it a candle where the next candle then closes above its high or low, right? Yes, okay, it's valid, I can draw on. And if you want to know if it's a flip, let me just kind of go through that. If you want to know if it's a flip, this zone, right? Just look, where did the reaction start? Look left. Are we reacting off any valid demand? Yes. Okay, cool. So it's definitely a flip. Do I want to know if it's a flip that swept liquidity? Did it take any high? Yes, it did. Okay. And you just kind of go through that process bit by bit and you're just adding layer by layer. Okay, cool. And sorry, I just forgot to add, you can do this on any time frame just to quickly prove it, right? We're here, daily chart on euro dollar. Now this was when price was trending really hard, so we didn't get that deep for pullbacks, but generally whenever you look left, what do old demand zones become when price is bearish? They become reaction points for pullbacks, right? So what do we get? Reaction from demand over here, fails to put in a higher high, and then we get a break and closure below the low. So that hole from the low to the top is your demand to supply flip range. What did it do? Without even zooming in, you can see it swept liquidity, right? We had an up movement, swept liquidity, moved to the downside. Obviously, you don't have to take that whole daily range. You can refine it to the extreme of the reaction leg, and then we get a continuation. And again, what do we pull back from? That's a pivot in price that broke structure. We know there's supply here. What do? We look left, and you can see we've come off this demand level here. Swept liquidity within there, right? Without even zooming in, that would be your extreme of the reaction leg. So at the moment, currently looking to see if price is going to make its way up there to see if we can get another bit of a pullback, right? Of course, we're within the whole weekly range at the moment, this whole buy to sell range. But it's just the same thing again and again and again. Then actually when we broke these major lows, there's no recent demand to work within, but there are, flips within structure as well. So let's see down here, right? What do we have? We have a daily demand zone that at least broke some structure there. And what did that reaction do? That reaction failed to put in a higher high. And then we broke and closed below. But what did it also do? It swept liquidity, right? We swept that high, then we swept that high again. So you've got that sweep right at the end, and that is your flip zone. Obviously, by the time we didn't revisit it straight away, by the time we did, we had then switched bullish with structure, right? We took the low, took the high. So now what do old supply zones to the left become? They just become reaction points for pullbacks. But how can they also be relevant even when price pushes through? Why would sometimes I leave an old zone that's now failed on my chart? Well, because it helps you paint the picture of that supply and demand interaction. What do we have? We had a reaction, failed to put a low, failed to put in break any structure. We broke and closed above it. So now you have a supply to demand flip. You can draw it from the top of the reaction to the bottom of the reaction, right? And there's your zone. Or of course you can refine it to the pivot candles within that, or down to the low. This one didn't actually sweep any liquidity. It's not a sweep flip because price just pushed back, right? And then came up. Didn't do anything, okay? And again, any old supply zones you've got over here, what do they become? Reaction points for pullbacks, right? And you can paint the story again. What do? We react from supply, failed to put in a clear lower low, break and close above. So again, anywhere from the top of that reaction to the bottom of the reaction is your flip zone, but that's massive. That's just the whole daily demand range, so we can refine it to the single candle pivot within that. Did it sweep liquidity? Yes, right? We can see that it swept the low there and it even swept the low behind there. So now we have this larger flip that swept liquidity, and that can look for a pretty nice level to potentially try and catch a daily high low, potentially up into that big flip that we were talking about over there, right? Where supply originally took control from that level down here, right? That swept liquidity, but because we're bullish, the assumption would be when we get up here that it's just going to be a pullback before we go higher. Of course, that could change. We could absolutely melt, but that's the expectation until otherwise. And that's how we start to paint all of this together. But we'll get into that more with trade ideas and introducing it with all the other concepts that we use very, very soon. Alrighty, so hopefully you are pretty comfortable or starting to get familiar with the idea of sweep zones, right? Those POIs that sweep liquidity as they are created as a potential additional signal that BFIs, institutions were involved in the creation of that POI, right? So now we can dive into the juicy topic of inducement. Now, liquidity in general and the topic of inducement specifically, it's something kind of over the years it's been a bit of a blind spot in my own trading. I've been aware of it, I've used it to a loose degree, but I've never dived deep enough into it and taken it seriously enough because I hadn't done it. I don't know, I'm not going to give excuses as to why, but I feel like I never really had a kind of systematic way of approaching it, which is now what we've been doing a lot of work on that topic and getting it to that point where we can try and make it as mechanical as possible. And also the point I'm trying to make here is that as the years have gone on, the months have gone by, I've realized it's becoming more and more important to my trading, and it's super important to try and reduce taking unnecessary losses, really. And when you start to spot it and you get it and you kind of have this systematic framework in place that would allow you to know exactly what to do in each scenario, it's super useful. But before, this is where we can get now over the next few lessons. It might feel like we're getting a little bit lost in the sauce, so I'm going to keep just drilling home this idea, the overall philosophy of what we're trying to do. And I think if you really understand the why, or at least the theory behind the why, it can help you to really grasp these concepts that we're about to dive into, over the next few lessons, where it can get quite technical. But if you can hold on to this, the idea of what we're trying to do here with liquidity, I think it can really help you to get your head around it, or at least it helps me. So let's go through it again, right? Won't spend ages on this, but we know very oversimplified version of what an order book could look like, where essentially on the left, we have price levels, right? Which is essentially just these prices over here. We know at every single line in the market, there's going to be supply and demand, obviously, if it's liquid, okay? So essentially this is where, imagine the current prices. So if you look at your broker and you're looking at euro dollar, if you go on MT4 or whatever, it will have a bid and it will have an ask. This will be the current bid price, 1013. This will be the current ask price, okay? And if you want to buy, you have to buy at the ask. You have to cross the spread. You have to buy up here. Why? Well, because that's where the nearest seller is. And if you're buying, you need a seller, okay? So if you want to buy, that is the current market price you would have to buy at if you wanted to enter straight away, okay? And obviously the difference is a spread. You have a 1 pip spread. That's where you need to go. And if you wanted to sell at the current market price, you would have to sell down here, right? You buy off the bid. That's the current highest bidder. So if you're selling, you would sell it off the person looking to buy from you at that price, okay? So if you are a large market participant and you want to buy and you want to get long, and you want to get long at the current market price, so you're going to have to start buying at 1014, and let's say you want to buy $700,000 worth of whatever currency, okay? There's only 500,000 worth volume being sold at the nearest price level. So if you were to just hit a market order of market buy, you would instantly fill that up, okay? And then your broker is going to look for the remaining 200,000 left of your order, right? And what's it going to do? It's going to skip this level because there's no one there. It's going to skip this level because there's no one there. It's going to hit that and it's going to absorb that 100. So now you've got 600,000 filled. Quick maths, what you need another 100K, right? And it will come up to here and it will take 100K off that level. So now you've got the majority of your order filled here, but then you get some of it partially filled up here and here, okay? So you essentially get slippage. All right. So if you're a big market participant, you want to reduce that as much as possible because you want to get filled at the best possible price, right? Ideally, there's at least 700,000 here for your order. So when you get in, you're in with your entire position here and not, some of it scattered all the way up here, right? So that's why we say for every buy order, it must have an equivalent sell order for a trade to take place, or not an equivalent order, but an equivalent amount of volume for you to get filled out, okay? So large market participants need an equally large opposing amount of supply or demand to enter and exit the market with minimal slippage, right? So hopefully I've really tried to drill that into you guys, and it will help you to now hold on to that idea that the big guys, they need as much liquidity as possible to enter, or at least that's the theory, right? It makes sense to me. So let's look at how we use this with our trading. Okay, so topic of inducement, there's a fair amount of words here. Okay, we'll dive into this in a minute. Of course, there's notes below the video, which you can read in your own time, but let's start with the sort of simple concept and we'll go from there, okay? So like I said over here, let's think about buying first. If you're a big guy and you want to buy, what do you need? You need a ton of people selling near the level in which you want to transact at. So if you need that sell side liquidity, okay, where on the price chart do we think there's going to be a lot of those sellers involved, right? And we've touched on this before. We want to look for where there's that sell side liquidity, which we know builds up below lows for different various reasons, okay? So in the market, if you have double bottoms building like this, what do we know people will be doing? They will be buying that support level or even the demand from within here, right? We know there'll be a lot of people getting long and having the stop losses behind the lows. So if you're long and you have a stop loss, what will that stop loss be? It will be a sell order because you'll need to sell back your position to the market if you're stopped out, okay? So when you see lows like that, sell side liquidity builds if people are getting long. Now you can have the exact same pattern, but another trader may view it in a different way. And they may go, well, if these lows break, they're significant lows, I want to short this, right? We think we're going to go, to zero or whatever. Or for some of you trade patterns, right? That's what people call a bear flag. And it's the exact same pattern as this, right? It's just equal lows, but that person wants to sell the break out of it. So even though this person's going long and this person's going short, what do? They both generate sell side liquidity because he's selling here and he's also selling here because he's selling back his long position, right? Another sort of example is where you would have a strong low, right? So a low that breaks the high, we could be looking to buy this. We could be looking to buy the demand that broke the high, and our stop losses are going to be behind that low. So what have we generated? We've generated more available sell side liquidity to the market, right? And what can happen is then we can get stopped out and then we get the movement, okay? So this is where people will often say my broker stop hunted me and all this stuff, manipulation, blah, 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 where you look like you just got stopped out and then it goes in your direction anyway. But what do we think is happening here? Well, like I said, if you're a big guy and you need to buy, you're going to be looking for where you think there's going to be a ton of sell side liquidity. And we know when there's obvious equal lows or, a strong low in the market, there's going to probably be a strong amount of sell side liquidity below there. And that's very often then where you'll see like a higher time frame POI, right? So imagine we've got some 4-hour demand. And if you're a big guy and you want to be buying, or we think the big guys are going to be buying from that demand level, and that's where we want to be getting long, what do they need to buy here? All right. Imagine this is like where we want to be getting long, where the institutions are potentially getting long, they're going to need this sell side liquidity, right? The money building below those lows, the people selling for the big guys to buy against, right? They need to buy against all of that sell volume so that they can get filled here and they don't, get filled here, here, and here, right? They want as much sell side liquidity, right, to buy into. They need people selling to them at this level, okay? So that's essentially the kind of bare bones idea of what we're trying to do here with the concept of inducement is we're looking for where has liquidity built in front of a POI, right? The opposing liquidity, so that can increase the probability that, if we're looking at, let me draw this, a POI, right? That broke structure. Okay, we want to see that liquidity be built in front of it because then the institutions can use that to get in potentially, right? And then the exact same opposite for buy side liquidity, right? Imagine, you want to be selling, or we think that this is a good POI. If we see that buy side liquidity build in front of it, right? People selling the double top, they've got their stop loss behind there, which will be a buy order, right? If you're short, you need to buy back your position, or people buying the breakout of the double top or the bull flag, whatever way they view it. Or again, if there's a strong high, people short the high, their stop loss, more buy side liquidity behind highs, right? So highs, we have the buy side liquidity behind it. And then if you've got a strong supply zone, right, like this, we think institutions are going to sell from here. They're going to need that buy side liquidity to sell into to reduce their slippage. Okay, so when we say inducement, right, the Oxford English Dictionary, the Oxford English Dictionary definition, God, that was a mouthful, ironic, is of inducement is a thing that persuades or leads someone to do something. Okay, so this pattern, right, these lows, the support level, whatever you want to call it, double bottom, whatever, it encourages market participants to think, okay, I want to buy here. I think this is a strong level. I think we're going to go up, and it induces them into the market to buy. It induces buyers, right? And that inducement by this pattern, this creation of these lows, it encourages them to get long. And what does that inducement create? It creates sell side liquidity. Okay, so in this instance, it's induced a buyer or buyers into the market to generate sell side liquidity. Okay, same pattern over here. It doesn't induce a buyer in this instance, it induces a seller, but it still generates the same thing. It generates sell side liquidity. Okay, so equal lows or strong lows in general, they induce buyers and sellers, but it generates sell side liquidity. Okay, for different reasons, but it all leads to the generation of sell side liquidity below lows, right? So patterns in the market will induce, just encourage, right? Entice market participants, so traders, to transact at certain levels. All that means is it will encourage you to take a trade here that will generate that sell side liquidity. That's all it basically means. Fancy words to say, if you see lows, sell side liquidity is likely going to build behind it. If you see highs, it's likely buy side liquidity is going to be building above those highs, right? And the more stronger the high, the more we can assume potentially there's more buy side liquidity. Like when we get nice, big, obvious equal highs, or we get a strong high, right? We can assume there's going to be more buy side liquidity behind it, okay? So what we say is those patterns that induce market participants generates available liquidity, so liquidity that hasn't been used yet. So this is fresh liquidity that a market participant, a BFI, can use to buy against for other market participants to use, right? So we look for the patterns to induce, to get you involved, to generate sell-side liquidity for BFIs to utilize, okay? So identifying inducement that generates that available liquidity in front of a POI that we're looking to get involved in, right? That can increase the probability of these POIs holding, right? It's just another signal that if you have a strong zone like this that led to a broker structure, or even one that maybe like swept liquidity, right, below that low, led to a breaker structure. If we then see inducement building here, it can increase the probability that, you know, they're going to use that liquidity to then fuel that movement, right? And that's what we're looking for, okay? And yeah, so available liquidity is those resting untapped orders. Obviously, this is when it's been tapped into, but before it's been tapped into when it's fresh, that's available liquidity. Inducement is essentially the pattern inducing market participants, buyers or sellers, but to generate that sell-side liquidity for other participants to use, right, to buy against. The liquidation is when the move actually happens, when price is tapped into that liquidity, these people are liquidated out of their positions, right? It's the liquidation, so market participants taken out of the market. And then sell-side liquidity, like I said, it's just the sell-side liquidity below the lows and then buy-side liquidity behind the highs. So super sort of, you know, let's again, not get too lost in the detail. Quick recap of what we've been doing. We looked at market structure, lower low, lower high, lower low, right? And we can see that that high broke the low. So we think that this is a strong high, right? Because it broke the low. So then what do? We look back and we go, okay, was there any supply in this level? And it's a strong or an institutional structure zone because it broke structure. Okay, happy days. Next level from that was then we looked at the concept of liquidity. Okay, and then what you may get is something like this, where this high breaks a low like that, right? And then we may get a pullback where price then sweeps the liquidity behind that strong high, right? To then fuel the move to the downside, okay? So we know that potentially an institution came in and they wanted to sell, but they wanted to use the buy side liquidity behind this high here to enter the market. So now we have, like we had over here, okay, we had a zone that broke structure. Again, we have that same thing, but it also swept liquidity within the creation of the zone. So it's another little tick in the box that potentially this is a, you know, an institutional zone, okay? Now, what we're going to be looking with inducement is kind of another simple way, I guess I try and think about to teach this is a sweep zone is kind of like in the past where we're looking at this zone, but it used the liquidity in the past for the institutions to enter the market. Let's say, right, the big guy used the liquidity behind here to enter. Okay, so that's a good sign that potentially this is a good POI we're interested in. But now the other thing we know is, let's imagine, they want to get short again or add more volume in here to get short. They're likely still going to need liquidity, buy side liquidity to sell against, right? So what you want to see is you want to see that inducement build in front of the POI again, right? So that when price comes in, there's that buy side liquidity that then they can sell against, okay? And there's basically two areas in which that can happen. It can either happen, if I draw this again, or I'll just do it here for the sake of time, right? It can either be built here, okay, where you'd have a bit of a pullback like that, right? And then you've got what? We know there'll be available liquidity behind that high, or it can be built in the pullback, right? Where you can get that buy side liquidity here, then price comes in, and then they've got all of this liquidity to sell against. Okay, so there's two areas. It will either be already available in the previous leg to the left, or it'll be built in the right, or we get both ideally. Okay, and that's what we're trying to do essentially now. Add in that another thing to help increase the probability that this POI may hold. So before we hop on the charts and kind of look at some real price action, kind of want to just go over one last example, because obviously we can have nice simple chart annotations on the whiteboard, but when you look at market price action, it can look a bit more erratic and quote unquote random like this, right? So how do we make sense of it? Well, first thing we always do is look at market structure, okay? And if we kind of just squint your eyes a bit and look at the bigger movement, what can we see? Impulse down, swing pullback there, next impulsive leg to the downside, swing pullback, and next potential impulsive leg to the downside, right? That's the overall skeleton, the framework that we want to build. So let's quickly just draw on, some market structure like this, right? And then this would be at this moment our current weak swing low. Okay, so some of you might want to always label this when you're in the market, because it can really help you to just remember where you are. Okay, and then we'd have up here our strong high, right? This is our current level that we expect to hold because it broke the previous low. All right, so now we have our strong high. Okay, so now we're starting to already make a bit more sense of what's going on here, right? We know what swing range we are playing within. Now let's just kind of start back here and build the picture a little bit. Because what do we have? We have a supply zone that led to a break of structure, right? So we have our higher time frame zone. Let's say it's the 4-hour price action, right? And let's just say we've got this big 4-hour zone up here, okay? But imagine what we're actually looking at here is this is the M15 price action, right? So we'd have if we went on the 4-hour chart, we'd have a nice 4-hour pivot zone here. And now we're on the M15 and we can see a bit more of the detailed price action within here. So if you look at the creation of that zone, what do we see? That price actually was up here, right? We had a high that broke that internal low there. Okay, so we know there'd be a decent amount of liquidity that would now build up behind that high because it broke the low, right? So there'll be people now looking to do what? They'll be looking to short this high here, right? So, we might even be doing that. We'll be looking at the supply that broke the low, buy side liquidity builds up, and then you get stopped out. So that's what we we're just talking about, right? With sweep zones, a sweep of strong structure that then leads to a break. So that's a decent sweep POI, right? That's swept a strong high. Okay, cool. And then we get that break of structure to the downside. Now, if we think about inducement, right? There's just, in this instance, just one straight push. There's no liquidity in the leg, right? You'd want to see something like that. We get a bit of a pullback, then there would be available buy side liquidity, but there isn't, okay? So whenever we have that, what I'll typically do is I'll use just an empty box like this, just to signal on my chart, just to remind myself that there's no strong liquidity in the leg there, okay? Now, what you'll kind of see, I'm kind of go loosely through this, and then in the next lesson or two, we'll make this a lot more systematic, okay? But I kind of just want to show you sort of what can typically happen in the market, right? Obviously, we know that not everyone, everyone's trading for different reasons at different levels, looking at different time frames. And they're not even trading; they're just transacting commercial volume. There's all sorts of activity going on. So when we get a pullback like this, right, higher high, price maybe comes into demand, fills some orders, right, we continue going up. Now, let's imagine there's people looking at like this 4-hour zone, right, or even a step before that. Let's just say someone zoomed in on the 5-minute chart and they're looking at, okay, price is making higher highs and higher lows. Their 5-minute is bullish. They see this trend line, right, and they want to buy here. Okay, so what are they doing? They're getting long, there's sell side liquidity below the low, and then what ends up happening is they can get smashed, right? So I'm going to try and do my best to sort of draw this as quickly as I can, but essentially you get that available sell side liquidity, right, that then price then targets and takes them out. then perhaps people get long on price coming into this demand range. Then you've got a break of structure here, so we've come up into our 4-hour supply zone. Then we get a break of that low, so perhaps that gives us our M15 zone, right? And then maybe this is something we're looking at, right? We pull back up into the high, the 4-hour zone. We want to get short. However, there's no inducement in that leg, right? You see how it's just a straight push? There's no liquidity built in there. So perhaps there's not enough liquidity for the big guys to keep selling from here, but we'll get short, right? So we do something like that. I say we, but just people who kind of trade supply and demand, who don't have these deep understandings of liquidity. And then, okay, nice tagged in, yep, sweet, happy days, can't wait to make some money, blah, blah, blah. And then boom, get stopped out. What happened there, right? I got liquidated. And then that happened that whole time is there could be people buying this trend line and think, okay, now they're in long, right? They bought on the third touch and they're getting on long at this, and then their position's starting to go in their favor. And then we got stopped out, and what we realized afterwards is, now there's just these big equal highs that were built behind us, right? There's all that buy side liquidity that was built, for anyone who's getting short on a double top or the supply zone, whatever way you want to view it. And then all of that liquidity gets taken into, and maybe it's now even more high probability because we've hit a refined M15 zone, right, at the extreme of that leg within there. Okay. But there'll still be people more buying this trend line. So this whole time, what's happening? There's just tons of liquidity building, sell side liquidity building below those lows. Now, perhaps now we've got let's draw on, right? We've got the breaker structure or chalk or whatever you want to look at, right? And we had our demand here, and now we have the demand reacted, fell to put in a higher high, and now we have our flip. And what also did that flip do? It swept liquidity behind that high, okay? So now you've got pull back up into the strong high, a mitigation of very refined M15 zone within the 4-hour zone. We now have a strong liquidation of those big equal highs that also broke structure. We've got a nice overall strong V-shaped momentum to the downside, right? Showing that momentum coming in, that overwhelming imbalance between supply and demand. We have a flip, right? It reacted to demand, fell to put in a higher high. It swept liquidity and moved to the downside. So now we have a flip that swept liquidity, broke structure, right? And then this becomes a much higher probability short position, right? And that's when eventually you can see that move eventually goes, right? So you might take 2 or 3 or 4 losses before the move goes. Now, what would have been even better, which I didn't draw, is there was no inducement in this leg, which some of you may have realized. So what would be even better is if you had something like that, right? And now you've got some inducement for this level here, okay? And that whole time when you're getting short here, what also has happened, you've got to think about all the other market participants trading for whatever reasons, having different views, right? You've got those equal lows there, right? People buying, potentially they see this as demand, they see that as a strong low that broke the high because they don't have a bigger idea of multi-time frame analysis or whatever reason, and then they're getting long in here because they've been stopped out here. Now they think the market's going the other way, right? If they got short here, they see that go. Now they want to buy the higher low to do that, and we've just generated more sell side liquidity below those equal lows. So now we've had liquidity taken, we can get short, and we've got liquidity to target, okay? And then all of the liquidity below there, the internal range liquidity, on a concept we'll talk about in a future lesson, and that's typically then when you get those impulsive movements. Targeting the liquidity below the weak low there, the external range, okay? So that's a lot more. Obviously, there's so many different variations in which ways that can happen, where just all of that liquidity and all of that sort of madness goes on, right, before you get the real move. And what we're going to be looking to do over the next few lessons is looking at kind of sort of the systematic way in which we're going to try and approach this and the exact things that we're going to look for in each time, okay? Because obviously price action is going to be unique in every single scenario, but we want to look for those specific key patterns to arise, and then we'll always know if this happens, then I do that. If that happens, then I do that. If this happens, then I do that. Rather than, what if? Is it going to take that? Is it going to do this? Is it going to do that? We're not going to worry about what is going to happen. We just know that if this presents, that's the decision I have to make, right? If this thing forms, then I always do this, because you're going to have that framework that you're going to have tested over time. And it's not going to give you 100% strike rate, of course, but you know that if you always just follow those rules, when this happens, I do that, then over the long course, you'll be okay. It's removing that hesitation from the market and trying to make yourself have that profitable edge over the long run, right? And then we'll start to make method of the madness, and hopefully not get sucked into those positions where you can end up becoming the liquidity. We want to wait for the liquidation and all the rest of it, and then we'll get involved. Okay, so before I ramble on any longer, let's take a bit of a loose look on the charts, and then we'll kind of really dive into the juicy details of those entry models.